how big these banks are in the unique bigness of J.P. Morgan.
Tom, you're absolutely right. I mean, our banks, in particular, the top three or even four, if you include Citigroup, J.P. Morgan, Bank of America, Wells, and Citigroup, are gigantic banks. And compared to, the days when we had money-centered banks like Manufacturers Hanover Trust or Chase Manhattan Chemical Bank, you look at the size of those banks, and they were the big banks in the 80s. These banks today are multiple sizes of that. So you're right. When you put out trillions, we used to throw around billions like it was nothing. Now it's trillions, and these companies are very, very large. And in the case of J.P. Morgan and Bank of America, extremely well managed.
How do you do a run rate on J.P. Morgan out 3 years of the famed Gerard Cassidy 7-year terminal value? John, 7 years out is when a lobster roll goes over $100 up in Portland. Maybe it's already there. But Gerard, how do you model it out? Is it a mid-single digit performer, high single digit, or can Jamie Dimon and his follower, can they do a true double-digit performance?
It's a great question, because when you think about the size of our biggest banks, banks, as we all know, are products of the economy. And our biggest banks grow at the nominal rate of GDP. So if you're thinking that the United States has real GDP growth of, let's call it 1%, 3% inflation, you're looking at mid-single digit top line growth. Now, they can enhance that to the bottom line through some positive operating leverage, meaning revenue growth is faster than expense growth, and then, of course, share repurchases. But if you can consistently, as one of our biggest banks, run your bottom line earnings in the high single digit earnings growth without any real disruptions over the long period, Tom, that creates very strong value for shareholders.
I like how you assume that Jamie Dimon won't be there in 7 years, Tom.
That's called doing an Iger.
Who knows?
That's doing an Iger.
You come back and you hang around to choose a successor.
You leave and then you come back.
How long before we start calling Bob Iger just the successor? I asked Ed Ludlow that yesterday.
I mean, and Cassidy, seriously, Gerard Cassidy is a guy who's lived banks without succession plans.
Gerard, work with me on this, because you know this far better than anyone out there. Gerard, when you start to raise interest rates at the Federal Reserve, typically what banks do is they try and pass that on to lenders before they try and pass that on to the deposit base. They're forced to do the latter. They want to do the former. How is that speed, that relationship between rates at the Fed and the pass-through to the deposit base and the pass-through to people borrowing? What does that look like now?
John, you're putting your thumb right on the one of the biggest points that people are going to be focused on this quarter is the so-called deposit beta. And that's, to your point, how quickly and how much do the banks pass on to their depositors relative to what the Fed has done. And it's been rather slow, but it's going to accelerate this quarter. We're going to see these deposit betas. I believe the Fed raised Fed funds rates in the second quarter by 50 basis points, and we expect to see many banks have deposit rates in excess of that. So the so-called deposit beta is over 100%. But that being said, we still have to remember these deposit betas are much lower than 2004 and 2006, when the loan-to-deposit ratios were much higher, and that's a governor on how fast these deposit betas go. We should also remember, John, if we get to a terminal rate on Fed funds by September, I would suggest that by the end of the year, deposit rates will not be going any higher. They burn out after the terminal rate is reached.
Have the higher rates at regional banks been working to attract deposits away from the biggest banks? And I say this after passing one of the regional banks with a sign, 5.5% rates on 6-month T-bills, basically. Put your money with us. You're getting, what, 0.1%? As Shanali just said at J.P. Morgan. Is it working?
Yes. What the banks do, they use the surgical instrument, certificates of deposit, to attract these deposits for the high rates, because they don't want to lift up their entire deposit book to 5.5%, because not all depositors are demanding that. So as a result, they use CDs. Today, coming into the first quarter, we had CDs as a percentage of total funding in banks around 10 to 11%. I would think in the second quarter, that's obviously going to go higher. But when you compare it to the historical times in the 80s, we had CDs as a percentage of bank funding at 50%. Now, CDs, there's nothing wrong with CDs. They're just expensive. And you will see this quarter, many banks will have much bigger funding coming from CDs than they did in the first quarter.
Just minutes away from the release, the likely release of JP Morgan. This is expected to be the first read, Gerard, of what the acquisition of First Republic really looked like and what they're planning to do with those assets. What are you expecting to learn? How important is it to get this read?
For the First Republic, when you think about the size of it, it was a big bank, don't get us wrong, in terms of failure. But to Tom's point about how big JP Morgan Chase is, it will have a positive impact, no doubt about it. But I think there's going to be a much bigger focus, and you guys touched on it earlier, on the investment banking results. There'll be a bigger focus on the consumer bank, which is their biggest division, the consumer and community banking area, and also on the net interest margin as well as credit. So don't get me wrong, First Republic will be looked at, but it's not the big swing factor this quarter, in our opinion.
Hey, Gerard, thank you. I know you're going to stay close and stick with us to break down these numbers when they drop. Gerard Cassidy there of RBC. JP Morgan just around the corner. Wells Fargo numbers as well. And then it's on to Citi a little bit later this morning, TK. We start to push through earnings season pretty quickly.
And each bank different and all that. I got to admit, I'm moving beyond the banks already after what we saw with PepsiCo and revenue growth at Frito-Lay. Seriously, we were making jokes about it, but folks, 14% revenue growth, 10% blended revenue growth at Pepsi. I'm fascinated how that carries over to the banks. Cassidy constructive, but then beyond as well.
Loan losses and loan loss reserves. Big focus on credit coming into this quarter, and I think a bit of pushback there, Lisa, from Gerard on that specific point.
This is going to be really key, not only what they see right now with loan losses going up and credit delinquencies, but what they're expecting going forward based on some of their surveys, based on credit card payments, based on some of the granular data, because this really may give the tea leaves that give a sense of whether Pepsi can continue doing what they're doing.
It's been quite a week, hasn't it?
It's been crazy.
The data, the earnings.
Yeah.
I'm pleased the earnings have finally arrived, because there was a moment there earlier this week when it got a bit snoozy. Was it Monday or Tuesday?
Both.
Just kind of like super sleepy, both Monday and Tuesday.
He was actually
no, Tuesday was wicked.
Yeah, exactly.
Tuesday was wicked nudgy, and what's interesting about wicked nudgy it's a Boston phrase.
Yeah.
But what's interesting here, John, is even the people that saw the soft landing coming, I think, are benumbed by it on a Friday. Even the people that got it right are like, oh. Euro 112. Wow.
Encouraged by the economic data so far this week. Let's see if it can continue. JP Morgan results here in New York. We'll break that down for you up next.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
DOJ or other authorities.
Could face bigger challenges.
Nixon's next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
because the bank failures put deposit costs and deposit growth in the spotlight, it feels like that is already priced into the stocks in terms of further pain. And I think the CPI print gives bank stocks some relief as we can see the light at the end of the proverbial tunnel in terms of Fed tightening.
Erica Najarian there of UBS. First out the gate, Wells Fargo. Looks like at first look, bit of a beat here. Shonali Bassett breaking this one down. Hey, Shonali.
A bit of a beat is good news for Wells Fargo. You have them coming in with revenue at about $20 billion, $20.5 billion above that $20 billion estimate. Now, why is this a good thing? Is because you are really worried about what the bottom line is going to look like, but as long as they're bringing in more at the top, it's a good thing. Interesting note here, there's an expectation this quarter that Wells Fargo is going to come in above Citigroup in terms of revenue that they're bringing into the table. You are still seeing pressure on the stock at first blush here, actually flipping a positive here because you do have also, I believe, EPS also beating estimates. The charge-offs coming in at 764 million, just above estimates, but nothing to cry home about. Now, remember, with Wells Fargo, we watch their consumer presence, particularly when it comes to the mortgage market. There's a question here about whether there'll be a greater delay here when we're thinking about those charge-offs when it comes to single-family homes. Net interest income coming in above expectations.
Let's work through JP Morgan as well. That's just come out. Second quarter EPS in at 475. Can break this down from division to division for you. Fixed sales and trading revenue in at $4.57 billion. The estimate $4.3 billion. Investment banking revenue in at $1.49 billion US dollars. The estimate $1.38 billion. A bit of commentary from Jamie Dimon expecting probable changes to come for bank liquidity. Shonali's going to get her teeth into that in just a moment. There's another headline that jumps out for me as well, Shonali, as you work through the same release. The provision for credit losses for the second quarter, $2.9 billion. The estimate $2.62. What jumps out to you?
I think that's a very, very important number here. You have managed net interest income coming in just above expectations. We knew JP Morgan was going to make money, but listen, those provisions, JP Morgan is the conservative bank on the street. So for that to come in above expectations will lead to more questions about how quickly these loans are converting into losses. JP Morgan has said time and time again that they want to lend, which comes with some losses. When you look at Wall Street's estimates, there's an expectation here that those provisions start to peak out in the coming quarter, this current quarter, but we'll listen for commentary on whether that is true or not, or whether there is more pain to come.
Unfair to you on this, but I'm looking at JP Morgan's quarter has after-tax gain of nearly $2 billion on First Republic, and my recollection was they alluded to this.
Yeah.
Are they bringing in this train wreck bank and making profit day one?
Well, listen, there were some parts of First Republic, and I will also say you have JP Morgan clipping at the heels of Silicon Valley Bank as well to bring on new customers when it comes to the technology industry, to bring on new people when it comes to people that could serve those high net worth individuals. So yes, you say train wreck of a bank, it did fail. However, they got this deal for a song with guarantees. And so when you look at their kind of day one lift from First Republic, that number is to be expected and nothing crazy. You also have him talking about probable changes for bank liquidity. I think that this is important because there's an expectation here that the future rules and regulations will start to impact the ROE you're getting from some of these
This bank's really struggling, John. I think when we're in Davos this year talking to Mr. Dimon or Mr. Pinto, Ms. Erdos, I mean, we've really got to be careful here. Gerard Cassidy with us here. And Gerard, when you and I were having a Narragansett on St. Patrick's Day up in Boston a few years ago, we were not modeling 25% return on tangible common equity, 20% return on common equity. Come on, Gerard, I've never seen those numbers. Is once again, Mr. Dimon and Mr. Pinto, are they going to have to hide how profitable this machine is?
Tom, I'm glad you brought that up because though, yes, the provision was slightly higher for JP Morgan, the message is that these companies are very profitable even with higher credit costs. And again, credit is critical on determining profitability through the cycle. And everybody's worried about credit. But as you guys just pointed out a moment ago, if we go into a soft landing, this profitability for the group is going to remain very strong. And Tom, it's going to be like back in 1995. The banks had a great year after in 1994 when everybody thought we were going to go into a recession in 95 and it never happened. This is lining up possibly to be very similar for JP Morgan and others.
Which raises a question, Gerard, of what this says about the broader economic backdrop. We are, as we get results from JP Morgan, the shares up about 2%. Jamie Dimon saying the consumer balance sheets remain healthy, saying the economy continues to be resilient, saying that they saw material growth across all sectors, even though they did miss slightly on equity sales and trading. From your vantage point, how clean of a read is this on broader economic growth and just the general path forward?
Lisa, it's very encouraging when you see numbers like this. To your point, it's broad-based. And when you look at the health of the economy and the leverage in the economy, the U.S. banking industry has been deleveraged because of what happened in 08-09. And the U.S. banks are in very strong shape handling what's going on today. And should this economy do a soft landing, and that's the critical piece, then the stocks will do well going over the next 12 months. But if we hit a hard landing, it's going to be very difficult for the banks, including JP Morgan, but that doesn't appear to be the case, at least today.
When you talk about credit losses, here's one tidbit. The JP Morgan second quarter provisions for credit losses are $2.9 billion versus $1.1 billion a year ago. You talked about the need to keep extending credit to get that interest, even at a time of slightly deteriorating credit. Is this a time of levering back up of the American consumer into perhaps a soft patch, but just not yet?
It's going to be interesting because we all remember what happened during the pandemic and all the stimulus payments. Consumers didn't need to borrow, and so they're borrowing now, and we're back at near record or at record levels, I should say, on consumer credit. But we got to remember, incomes have gone up over the last 3 or 4 years considerably, and they can handle this. You look at the debt service coverage of the consumer, and it's still well below the levels of 2006. And to your point on the provisions, we have in our model for JP Morgan this year, they're going to put up about $11.3 billion in provisions, and last year they were 6.4. And to Tom's point, they're still putting up 20% return on equity. That's the point. They can handle the higher provisions because business at on the revenue side are still quite strong.
Let's get the pre-market price action on the screen. JP Morgan results out just moments ago, together with Wells Fargo. A beat and a beat. JP Morgan up by about 3% in the pre-market right now. Let's just work through some of this together, Shanali. I want to bring you back in. Jamie Dimon is saying all the right things about various business lines, but then he mentions this about investment banking fees. They remain challenged. Is that going to be something that stands out for you for this quarter, not just from JP Morgan, but others as well?
For the big consumer banks, it still comes down to what they're doing with the consumer here. You're seeing average loans up 13%. But on the investment banking front, remember, why do people like investment banking? All you're really paying is your banker. They took some money off their corporate book here. You see some losses being taken there. So I do wonder about underwriting when it comes to the leverage loan markets, when it comes to other corporate underwriting standards as well as the consumer. Because if you take a look, what's interesting is some of these provisions, they're actually because of First Republic as well. So I think the market can let that go a little bit. They're bringing on a new book here. To the point that Gerard and everyone has been making all morning, not just 20% return on equity, 25% return on tangible common equity. I mean, these are blowout profits for JP Morgan, regardless of that softness in investment banking. But with that said, to Tom's point, they are one of the banks that have been laying people off by the dozen.
You buried it in a PowerPoint, and I really want to congratulate all the PR people at JP Morgan. There's some real clarity to it. John, you take dividends, you take share buybacks of almost $2 billion.
I apologize.
33% payout. They have so much wiggle room to give out more money. They're like Apple. They got so much air to go beyond given any stresses.
I believe that is a beat and a raise. The estimate for net interest income at about $87 billion US. It had been previously $84 billion. So, Shanali, can we call that this morning a beat and a raise from JP Morgan?
We can. You know what's interesting about it, too? Even in the investment bank, they're not losing money everywhere. Fixed income, if you take a look at it, for example, the higher revenue was in the securitized products group. That sounds kind of boring, but it is one of the hottest businesses on Wall Street. JP Morgan has guided us to look at it. So even if they have competition left, right, and center from private markets or whatever, that group is doing quite well, which means that things are being offloaded into the market, and you could potentially continue to see that. That is capital markets coming back.
Shanali, stick around. That's Wells Fargo and JP Morgan behind us. In front of us still this morning, Citi, then on to next week, Bank of America, Morgan Stanley and Goldman Sachs. Just about 10 minutes away, we'll catch up with Ken Leon of CFRA. Anastasia Amoroso of iCapital coming up shortly as well. Off the back of those results, JP Morgan positive in the pre-market. S&P 500 futures just about turning positive as well. On the S&P up by 0.05% after gains on Monday, Tuesday, Wednesday, Thursday. Let's see if we can make some gains in this equity market this Friday.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
Inflation should be going down. The economy is slowing.
Not expecting.
Coming through from JP Morgan, Wells Fargo, at Citi. Up next, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Bramford, I'm Jonathan Ferro. Equity futures just turning positive in the last 20 minutes or so on the S&P 500. JP Morgan up in the pre-market. It's a beat and a raise, Tom, from Jamie Dimon and the team.
Beat and a raise, and it really shows the quality here. I want to be clear, every bank's a different story. With Citigroup coming later, it's going to be a completely different take. What I find interesting here, and this goes back to our conversation with Senator Warren a few days ago, in the defense of anyone, of any party, We need to learn the ginormousness of these banks. They hide it every day. I happen to be looking, John, at the paragraphs here in bullet points on asset and wealth management with some footnotes here about weakness in the quarter because of travel. But other than that, we've got expenses up 8%, but revenues up 11%. $3 trillion, up 2% on assets under management. I mean, even asset management is phenomenal.
Let's get to what Jamie Dimon had to say just moments ago. Almost all lines of our business saw continued growth. That's the happy talk. Let's park the happy talk for just a second.
Yes.
Lisa, outside of all of that, and we have to give it a mention, provisions for credit losses just creeping a little bit higher. You had your eye on that. I did too. Others have as well coming into this quarter. That's still a focus.
This is an expected result of what we are seeing and we're expecting to see of consumers spending perhaps a little bit less. We did hear that from Jamie Dimon saying consumers are spending, albeit a little more slowly. How much does that really speak to what's to come down the line at a time where they're increasing their net interest income well more than anyone expected? So they're still lending because they're earning so much. And just to give you some numbers around that, Wells Fargo reported $13.2 billion in net interest income for the quarter. That's up 29% from a year ago.
Right.
And just like JP Morgan, it was a beat and a raise, saying that it was probably going to rise 14% for the full year.
Just very quickly here, on a conference call, maybe you don't ask this, but on the research call, I want to know what commercial real estate does to these various banks. That's what I don't see in the PowerPoints.
We'll hear more about that a little bit later.
Yeah.
Most likely from the analysts on Wall Street who we'll catch up with. We'll speak to Ken Leon in just a moment. Look out for that. In around about 48, 58 minutes from now, we might hear from Citi too. Lisa's going to give you the guide for what to look for this morning in just a moment. What to look for in the market. JP Morgan up in the pre-market. Citi, Wells Fargo running as well. Early days, let's see if that sticks. But equity futures turn positive on the S&P. 4-day winning streak on the S&P 500 into Friday. Let's see if we can make that day 5. Equity futures positive by close to 0.1%. Yields have been down all week. They're up this morning by a couple of basis points on a 10-year to just short of 380. And in the FX market, the euro's been strong all week, he said this morning. That rally takes a pause, Lisa. Euro dollar slightly negative.
The rally in bank shares not taking a pause as we get the early results out of the big banks. JP Morgan and Wells Fargo both reported about 15, 20 minutes ago. We are expecting Citigroup around 8 a.m. The analyst calls, this will be key to really understand the granularity behind some of the loan loss provisions and what they're expecting with respect to the economy. 8:30 a.m. for JP Morgan, 10 a.m. for Wells Fargo, at 11 a.m. for Citigroup. At 10 a.m. we get the latest economic data read, University of Michigan Consumer Sentiment Survey. It is expected to increase. Again, this speaks to the soft landing narrative that has gotten everybody worked into a frenzy of the everything rally of this week. And today the NASDAQ is grappling with how to understand the dominance of the 6 biggest tech players. They are going to readjust. They are announcing the details around this new rebalancing to bring down the total concentration of those big stocks to below 50% so that they don't breach regulatory hurdles for a lot of the funds that are tracking these indexes.
For all of you distracted by this, I'm really glad you bring this up. This is a huge deal to the equity market. This is not just another thing, and I'll read every single word I can on this. It's not like a joke about the Dow and the S&P 500. It's like, I feel like it's almost nifty 50. Johnson & Johnson, a million years ago. Our world has changed. How do we mathematically adjust to it? It's not a small matter.
A lot going on this morning, but our lead story, JP Morgan in the pre-market up by 2.8%. Ken Leon, the Director of Equity Research at CFRA, joins us now for more. Ken, should I be focused on the beat, the raise, or the provisions for credit losses?
I think focus on the economy and the strength of the results and performance. And what this means is, you know, banks are kind of peculiar. You build reserves mostly for loan losses and also looking ahead to perhaps weaker performance. Sometimes you have loan loss reversals. We had that a year ago. So what's likely now is if we have a soft landing, not a recession in the second half of this year, the likelihood is these provisions begin to slow down and possibly the reserves may be too high in 2024 when you have an ability to beat much better comparisons to 23. This was a good quarter. We thought this would be the trough of the investment banking cycle, and we are seeing green shoots. but the strength of the consumer and commercial loan activity is very promising, and size matters here, and that's been your discussion in the last half hour.
Ken Leon, that's where I wanted to go on size it matter. I'm going to give you two, buried in a PowerPoint, Ken Leon, and I know you know this and probably knew it already. 35% pre-tax margin on JP Morgan Asset and Wealth Management. 35% on the dollar. Folks, that's almost like, it's not in the textbooks is how I'd put that. And what's so important to me, Ken, the return on equity within Mariotta's system leaps from a 25 blend system up to 34% ROE. Have you ever seen a big profit machine like that in asset and wealth management?
You know, it's amazing, Thomas. JP Morgan has done this, you know, with less fanfare than others, such as James Gorman at Morgan Stanley, that took it from 12 to 25% and probably 30. These are phenomenal numbers, and it speaks to making the right strategic decision to expand in asset and wealth management. That's what Goldman Sachs, unfortunately, will have to talk about next week, where they made the wrong turn and they're trying to play catch up in these amazing areas.
Lisa, that's exactly where I wanted to go. This is not about, I've never seen this before from JP Morgan and what the improvement was at Gorman coming ages ago. This is about the ones that aren't doing it.
And we're going to look to that next week in particular. Ken, I'm curious your take on the net interest income coming in so strong, upgrading that for the full year at a time when a lot of people are critical of the big banks for not passing along those extra profits to depositors more quickly, akin to what we're seeing over in the regionals.
Yeah, that's right. And we have a beautiful chart somewhere, but basically it's 2 points. You have one lever, which is rates, and rates might have peaked. But if you have increased loan activity, that will spur net interest margins and maybe keep the earnings asset yields at decent spreads, even though we have this disintermediation where depositors are looking for 5% or so. This is really promising. For the larger banks, it's about 55% of total net revenue. As to your point, Lisa, you get a little bit more downstream. It's 65% or more. So that might help the smaller banks, and we're going to be watching that at CFRA.
What are we seeing, Ken, with respect to depositors getting sick of earning nothing on what they are parking at these banks and moving and actually shifting into CDs, into income-producing instruments? Is this causing any kind of pressure, or have we seen a surprising stickiness of these deposits that will allow this type of net interest income to continue?
Yeah, so that continues. That's far the biggest macro trend is this pivot to getting higher yield. And additionally, there's, of course, non-interest-bearing deposits and deposits that are there because you're a small business doing business like with Bank of America and you have relationships. So, you know, I think that will continue. But if we reach next week where we've reached the Fed finishing its rate rise regime and pause, and then perhaps cut next year, this will be less of a factor.
Ken, can we just finish on regulatory overhang? Bit of pushback, I think, then in the statement this morning from JP Morgan. I just wonder how much of an overhang that's going to be on the whole group of stocks in the banking sector.
100%, and that's where I would have started this conversation, was Michael Barr's holistic capital approach that we studied rigorously that talks about the interplay of liquidity and capital risk, and taking $2 for every $100 for risk-weighted assets. But, you know, capital will increase. If I'm an investor, I'm looking at total return, this might put some kind of ceiling on buybacks that none of the banks did. Those in the Dodd-Frank stress tests were allowed to do, but they had dividend increase. Capital and return of capital is what Jamie Dimon's most worried about, because a sophisticated investor may say, I may go elsewhere.
Ken, thank you, sir. Ken Leon of CFRA. We'll check back in again with you a little bit later in the next hour. We've heard from Wells Fargo, from JP Morgan. A little bit later this morning, 50 minutes away, we'll hear from Citi. If we can check out the price action of those three names right now, all three of them positive in the pre-market. JP Morgan, Wells, and Citi, up, 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 and away. We're positive on equity futures as well, on the S&P 500 by 0.1%. JP Morgan up by 2.5%. Tom, Wells up by 2.7%. Citi up by close to 2%.
I wonder Wall Street.
Prime Day, best sales day ever over at Amazon. Did you see that headline?
I've read some of it.
Yeah.
Citigroup had Ron Josie had a really smart note out on this, and he really tore it apart. What I don't understand, because I'm really not playing the game, is it benefits all. Prime Day is not just about Amazon. It's about everybody else competing, reacting in that, and go over to Target or wherever. And it's an online day, almost more than a Prime Day.
This has been a theme. We've heard this from the early earnings pretty much across the board. The consumer is still strong. The economy doesn't seem to be losing steam that fast. Perhaps they're spending a little bit less, but not necessarily, especially with Amazon Prime. So now this goes for the banks into the question of regulatory overhang. When do they potentially fight back? Is that priced in? And then how do we get a recession if we have this type of situation, just let me finish, where you have consumers still strong?
See, that's like in the kitchen. Lisa, my point is we're worried about regulatory overhang. I've never seen those numbers in JP Morgan as a blended idea, asset management. Everyone in the world has to react to that. My answer is everyone worldwide, Latin America, Asia, they're going, I'm scared. Where are they throwing money? JP Morgan, and they'll pay whatever it takes.
You finish fighting.
No, we're not fighting. It's
It's a disagreement.
No.
You're just disappointed with each other.
Yes.
You're not angry.
I feel vulnerable, though.
We don't do passive
I'll get to the
aggressive.
headline from
Right,
JP Morgan. No, not at all. Not at all. We caution the impact of material regulatory changes. That's the little bit of pushback this morning. JP Morgan up in a pre-market. Equity futures right now positive too. If you are just tuning in, welcome to the program. Equities up by 0.08%. It's been quite a week for the equity market, quite a week for the bond market too. Coming up very shortly, Megan Swiber of Bank of America Securities on interest rates. We'll catch up with her in about 20 minutes' time. The guide, the playbook through the rest of this morning. You've heard from Wells, you've heard from JP. You're going to hear from Citi. And Jane Fraser, Tom, in about 47 minutes.
Totally different bank. They want to give you an international spin. It's going to be fascinating to see what she's pulling back on. As I mentioned to Chanel Bassick, I don't think this is a normal right-sizing season. July now feels like it should be October, and there's going to be a lot of tough decisions made. I'm really interested what the tough decisions are at a Citigroup that's been basically challenged for a decade.
What's left to pull back on over a Citi?
That's true. Where are we in terms of cutting to the bone? It's a cliche, but it's also, I think, John, it's a very valid observation.
Chanel's going to drop by in the next hour too. Looking forward to that. Anastasia Amoroso of iCapital coming up shortly. Called this equity market rally a number of months ago, and that rally this week, Tom, has continued.
And does she stay with it? You know?
Yeah.
That's the heart of the matter.
Anastasia Amoroso of iCapital coming up next.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Earnings season is
Are we
coming.
going to see cracks start to emerge? This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
It was very clear that inflation was and still is at levels that are too high for their comfort. The lagged effects of Fed hikes will eventually begin to slow things down. We're already seeing that across all indicators. We are nowhere near the 2% target where they want it to be. And with that backdrop, of course, they will continue to say, we just got to keep going.
And that's exactly what they're saying. Torsten Slock, Apollo Global Management Chief Economist, weighing in on the long and variable lags of the Federal Reserve, the rate hiking cycle of the last year plus, and the tightening that's going to bite into this economy in the months ahead of us. Equity futures right now positive by 0.1% on the S&P 500. There's a lift in this equity market, a lift in the pre-market as well. JP Morgan, Citi, Wells Fargo positive after results from JP Morgan, Jamie Dimon, and from Wells Fargo as well. JP Morgan in the pre-market, a lift here, Lisa, up by 2.4%. Wells up by 3%.
A lot of this is the net interest income, which is coming in more bigger than expected, as well as an upgrade in terms of longer-term expectations. Again, big banks are getting their capital for free, and they're lending it out at the highest interest rates going back decades. This is the underpinning for record revenues, which we have seen quarter after quarter.
And it's a regime shift for a huge body of the Bloomberg surveillance audience. They've never seen somewhat normative rates, John, a legitimate real rate, a sharp ratio you can actually calculate. And to borrow from Torsten Slock, what are the long and variable lags of JP Morgan, the long and variable lags of James Dimon? And to me, it's use of cash where they're delivering 33% to dividend growth and to share buyback. And that's teens weens for a scale of that size. They've got room to move to deliver cash to shareholders.
Early days, but decent start to earnings season in the last 24 hours. PepsiCo, Delta, JP Morgan, Wells Fargo, Citi still to come.
We're trying to get perspective here, and we've heard a lot from bears vacillating, readjusting up. Anastasia Amoroso, Chief Investment Strategist at iCapital, she doesn't have to vamp it up at all. She nailed it, the market up. Let's go back in history. What did you see in October? What did you see that was enthusiasm for the market?
Back in October, what we saw were valuations that were discounting a lot. I mean, if you looked across the equity markets, you've had the S&P that was trading, I think at the time, in the 40th percentile over the last 15 years. If you look at investment grade and high yield bonds that were trading, you know, in the 9th or 10th percentile of their respective ranges. So we were discounting a lot. And then positioning, I mean, Tom, could you get anybody to invest in any risk asset in October of last year? The answer is no. And then ultimately, the catalyst, you always need a catalyst. What we saw was that by the middle of this year, there was likely to be this gap that was going to open up between where the level of Fed funds rate is and where inflation was going to be. And that gap was going to be positive, meaning Fed funds rate is above the rate of core inflation. And that's sort of what we are today. And I think that's what's been happening in the last 6 months. We've incrementally been getting closer and closer to that pivot point. But as you know, markets price that in advance.
So what next? I guess it's the question. You know, you've rode this equity market, bull market, if you want to call it that, year to date. What are you doing now?
I mean, you stick with it. You stick with it. And, you know, for now, I think we are on track for a soft landing. And I know, you know, the bearish camp would say, well, you look at positioning and it's getting very exuberant, you know, by some metrics. You look at, you know, whether it's hedge funds, whether it's CTAs, all of those investors have, you know, very quickly, very bullishly positioned. So, you know, that leaves you susceptible to a negative catalyst. But can you name a negative catalyst right now? You know, if we've got inflation that is easing, we've got the Fed that is pausing, and, you know, Lisa, you talk about this all the time. If you've got the consumer that is strong and is not going anywhere, you know, then where's this equity market going to go? You know, so for now, I think when I square the valuations, which is supported around these levels, and when I square that with 2024 earnings, which, by the way, have been de-risked a lot, that gives you close to 4,800 on the S&P.
And just to let you know, I could give you numerous catastrophic situations that could potentially happen to curtail it, but that doesn't look likely. And that is the underscored point here, that we are seeing seeing less headwinds to this rally continuing, which raises a question of leadership. How much do you shift away from what's done best so far to some of the small cap areas, the financials, after seeing the results that we've seen just this morning?
Yeah, well, I think you stick with tech because tech, of course, is where the growth is and is going to continue to be. And I am a big fan of artificial intelligence. I think that's a huge trend that is adding to earnings of companies starting today. So you stick with tech, but at the same time, Lisa, I'm really coming around on financials. And, you know, if you look at the earnings results this morning, there's not much to be disappointed about. You know, yes, we know deposit betas are going to rise, but guess what? That's priced in. You know, yes, we know lending is going to be slower, but that's also baked into the cake. And what I'm actually encouraged about for financials are two things that I don't think are yet priced in. The first one is the possibility of a steeper yield curve. If we are in fact in a soft landing scenario, that at some point the Fed is going to pause and maybe even ease if inflation really comes down, and if the economy is still on track, then the back part of the curve should actually hold up.
The only thing that someone could say if they were bearish, and Tom would grunt, and he would say, oh, come on, I can't stand this. The concept of regulatory overhang.
Yeah.
If perhaps these banks do too well, and suddenly the supervisors and Congress members decry that and try to put more constraints on them, is that something you're watching?
Yeah, it does need to be baked into the models for sure, but I would say it's a one-time risk. That's a one-time adjustment that would have to be made. And guess what? It's also being talked about in the research reports. But the other thing, again, that I don't think is yet baked in, you know, possibility of steeper yield curve, but also the possibility of deal activity picking up. I know that in some of the results that we're seeing today, you know, there's not much to write home about when it comes to IPO volumes or M&A, but I think conditions are starting to be in place for capital markets to really open up in the back half of the year. So that means more IPO volumes, more announced M&A deals, which, by the way, picked up this quarter, more of them getting done. And that's positive for banks. It's positive for alternative asset managers, for all the PE companies, private equity companies that will have the exit opportunities they haven't had.
Let's get concise. Do you see a second leg of a bull market to a fossil like me that's early 1976? And what's an SPX called? Don't give me this 90-day garbage that you do. Give me like a 1 year, 2 year, 3 year view. I'm scared stiff. I've missed this. I need to participate. Do I have a luxury of a second leg of a bull market?
I'll give you a 6-month view of that.
She's really reaching out, John. 6 months.
You know, it's somewhere between the 90-day and the 1 year. But the 6-month view, I think we do push higher towards 4,800 on the S&P. And I'm a little bit more cautious going to 2024 because, you know, if we are at a point where the real rates do become restrictive, you know, at some point we may actually have a downturn in the economy. So I don't want to pre-trade that. So that's why I'm sticking with it. But at some point in 2024, we might have to have a different conversation.
It's been a great call so far this year. Congratulations, Anastasia Amoroso of iCapital. Been bullish on this equity market. Been right to be bullish. TK looking for record highs later this month, in the month of July. Yeah,
to frame her critical comment on real yields, and I did a study of where was the 10-year real yield pre-2008, and the answer is 2.03, 2.05%. A lot of fancy math. Most experts I'm talking to, John, say we're not going to get back there. The real yield this morning has come lower the last couple of days in this celebration, 1.53%. And I'd say there's a center tendency of 1.5 to 1.7 is sort of a healthy real yield. And, you know, you wonder with the dynamics of the system how that will play out. Do you get the real yield that Anastasia's talking about that impinges a bull market?
Anastasia mentioned the banks coming around to the financials. Laurie Calvasina, we'll catch up with her a little bit later. Laurie upgrading the banks overnight, a lift to her earnings forecast. But Lisa, going to overweight financials, and after the results this morning, perhaps encouraged by that.
Absolutely, especially at a time where they're gaining so much income from the consumer lending portion of their books, as well as the potentials Anastasia was talking about for deal making to pick back up. Wells Fargo saying that its average deposit cost soared to 1.1%, up from a measly 0.04% compared to the, say, 5.5% being offered at some of the regional banks. So, yes, they're passing it along, but not nearly at the pace seen in some other firms.
It's pathetic, isn't it?
It's pathetic. Yes,
really
exactly.
Pathetic.
As a
TK,
depositor.
1% on deposits. I guess they can get away with what they can get away with.
Okay, this goes right to asset management.
Get away with it.
There are people, John, on airplanes traveling worldwide, and people are throwing money at JP Morgan just for the name. I mean, it's that easy. They don't have to work. All they got to do is show up, and people go, JP Morgan, and I'll give you 0.2% interest.
Yay. Equities, slightly positive. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Citi's Andrew Hollenhorst making a move on rates, just published moments ago. Looking for a hike in July. They were looking for a hike in September, no longer. We now expect a skip in September with the subsequent and possibly last of this cycle hike delivered in November. On the soft inflation patch, the soft spot might last for several months and possibly the remainder of the year, but still tight labor markets and a rebounding housing market risk a reacceleration in inflation late this year or early next year. That's the latest from Hollenhorst. So that's a shift off the back of the information we've learned, Tom, this week.
I remember sitting with Steve Roach, I'll say 20 years ago, John, over the invention of this phrase soft patch. And Roach just going, what have we become? What is a soft patch?
A soft patch means a temporary reduction in inflation pressures, Tom, which could reaccelerate.
And to a point, Howland Horse has done better on this than James Bullard.
On the hiking cycle, without a doubt, he's been better than the Fed.
Howland Horse has just killed it. And for him to go to a hawkish pause or dovish pause or that, we got to get somebody to write a paragraph where they get V-shaped, soft patch, and a hawkish pause.
Well, let's establish the two camps right now. Let's be careful about this. There are two camps at the moment. There is one camp who think this is it. We're on that sustainable trend on our way back to 2% without any damage done to the labour market. There are others who think that what is happening in the labour market right now is inconsistent with a sustainable path back towards 2%. And they believe you might get that soft patch through summer and potentially reaccelerate later this year. Lisa, they're the two camps right now.
And it's just sort of accelerated the debate when you hear likes of Jamie Dimon saying that the consumer is still spending and that there's still a lot of strength in the economy. Can you have strength in the economy and ongoing disinflation once the comps get a little bit less easy to sort of hurdle, right? This is the question heading into next year.
That's the debate for bonds. For equities and FX as well, I guess. In equities right now, on the S&P 500, futures shaping up as follows. Lisa's going to bring you the bank earnings in just a moment, but that provided a bit of a lift to the S&P 500 in the last 60 minutes or so. The S&P turning positive by 0.1%. JP, Wells behind us, Citi still to come. In the bond market, 2-year, 10-year, 30-year. What a move on a week on a 2-year yield, down by almost 30 basis points so far this week, up by not even a basis point now on a 2-year to 463. And with that move in the bond market, the dollar a whole lot weaker. Push it through foreign exchange. The euro now positive for a 7th consecutive session against the dollar. The euro slightly positive, Lisa, to 112.33.
We haven't focused very much on the banks. JP Morgan, the first of the ones we're going to look at, although Wells Fargo came out first. Again, across the board beats, and the beats are notable for the magnitude. JP Morgan reporting a record revenue in the second quarter, reporting $41.3 billion. That is just in one quarter, beating expectations. They also lifted guidance for the net interest income. Those shares up 3%. Wells Fargo also lifting expectations for net interest income, given the fact that they're paying, 1% to their depositors, a whole 1% from nothing a year earlier, basically saying that they expect their income to jump 14% for the full year. Previously, they had said 10%. Citigroup coming out in just about a half an hour here. Those shares up about 2%. A lot more questions around Citigroup and some of the reorganization. But if you look at year to date, and when we talk to investors about where they see the opportunities, here's why. JP Morgan shares up 11%. When you compare that to NVIDIA's 4,000% or whatever you're going to call it, gains, you start to say, why are they underperforming if they're continuing to deliver these types of results? Wells Fargo up almost 6%, Citigroup up 5.4%. Do you start to see more investors rotate into financials because of just the sheer revenue from the interest increases that we've seen from the Fed that they don't have to pass along to depositors? Because evidently depositors don't need to get paid
you feel very passionate about that, don't you?
Well, I think that's one of the key questions, because this gap is just clearly taking money from depositors that are not getting anything.
It's one of those
on their
business lines.
savings.
Any other business, we'd be like, yeah, you know, they've got to make money. But when it comes to banks, we're like,
well, it's
pass
personal.
It on.
Well,
pass
if you think about it, you're getting
nothing for everyone with
from,
money in the bank.
Exactly. And so you think about these ballooning deposit accounts. You're giving them free money to work with, and they're making bank with it.
Well, very quickly,
Literally.
one of the first things I heard, John, ever was from a banker of a small, tiny bank. And I said, why haven't you merged with somebody? You know, it's the smartest thing I ever heard. He said, Tom, we like to go to lunch. And it's such a, you know, at the small bank level, you know, they're just trying to keep at it so they can go to the Rotary meeting, the lunch, whatever. Why are the super regionals any different? If I'm one of the 15 banks underneath these guys, and I'm looking at JP Morgan's earnings today, why aren't the super regionals merging? I don't get it.
Well, some of those banks were out for lunch, weren't they, in the last year or so?
Yeah, I think so.
Yeah, quite literally.
You know, I just, you know, Sonali Bassick says it nicely in a note, many wins for JP Morgan. There's also many wins for getting the bond market right. Megan Swiber joins us right now, Director of U.S. Rates Strategy at Bank of America. This is a brutal job. Does Moynihan call you up to get a briefing? Farrow's big on this. Like, Brian's like wicked informed. from his research staff. He harasses Ethan Harris at home on the weekend. Does he call you up to say, what's a terminal rate?
You know, occasionally here and there. But, you know, I would say that that's just been really the focus of markets more broadly, right? Is ultimately what it's going to come down to is what is the Fed going to do at the next meeting? Where does neutral sit? And that's been very important for the bond market. But of course, as we were just talking about, the equity market and
okay, but you did your Fibonacci, and there's got to be a mathematics that you go out to a place. We're back to a normal environment for fossils like me that we haven't seen in 16 years. What's the new, you know, in terms of terminal uncertainty, what's the new terminal rate you're working with?
So, Tom, what it comes down to right now is the inflation picture. And part of the reason why we've been able to see rates rally so much this week is at the end of the day, we got a pretty promising CPI report. And when you're looking at inflation being able to moderate, you know, when we dive into the details.
What's that do to the terminal rate?
What it does to the terminal rate is it reduces how much more we think the Fed will have to go. If we listen to more of the hawks on the committee, them suggesting that there's still more room for the Fed to hike, what it comes down to is whether or not inflation is persistent or not. This core services ex-housing component that Powell's really anchored the market on printed at 0% month over month in the most recent reading. So it takes a little bit of the wind out of the sails of the more hawkish camp here.
One thing I can get hawks and doves to agree on right now is this soft summer patch for inflation.
Yes, exactly.
Then there's this divide that starts to emerge later this year, as you know, Megan, about the potential to reaccelerate. Where are you and the team on that?
So we are of the view that in the long run, inflation will be able to settle back to 2%. And I think that that's right. There is really this divergence between, are we going to settle now closer to 3% by the end of the year, or is that going to be closer to 2.5%? What I'll say right now is that we're a little bit more so in the stickier inflation near-term camp. When I look at what the market's pricing, though, you look at one-year inflation swaps sitting below 2.2% this morning. Even with our house view for a mild recession starting in the first half of next year, that's still about 40 basis points or so below where we're expecting. So I will say that the market seems to be very overly optimistic around where inflation's going to settle, even over the near term. And I think what it will come down to about this question of how quickly they're going to be able to see inflation moderate down to the target, it's going to be a matter of how strong the U.S. economy will continue to be. And a lot of that economic resilience does skew the risks, I think, near term towards more persistent prints.
Then do you think that it's too early to get bullish on longer-term bonds at a time when perhaps the market is overpricing the idea of this soft landing that yields low inflation, robust growth, and everything can chug along?
So I think, Lisa, what this presents for us right now is when we look at what the market's pricing across the curve, I think it's too early to get bullish on the front end of the curve. And as was just highlighted, right, we've seen really that very notable rally in the 2-year rate. I think what makes more sense right now from the investor perspective is going long further out the curve, actually closer to the 10-year point. And that's because when we look at prior hiking cycles, right, when you look at how the market performs 12 months after the Fed delivers that final hike, you usually see 10s rally on average about 100 basis points over that 12-month period. The ability for the front end to really come down is going to be a question more so about when does the Fed deliver these cuts.
You talk about basically a real deepening in the yield curve inversion, and this would be a re-steepening or re-inversion down to near record lows, or at least post-1981. What does that mean in terms of some of the dynamics that we're talking about this morning with banks, and whether that increases the risk of this shallow recession becoming something a little bit more?
Yeah, so deeper inversion will put more pressure on banks for sure. But what I think the curve inversion is really telling us right now, it's not so much so reflecting recession concerns, as some of these recession probability models will tell us. What it's reflecting is expectations for the Fed to cut. And the Fed cutting alongside inflation that's able to moderate back down to its target makes sense. The Fed thinks about setting interest rates through the real rate. So a 5% Fed funds rate is different when inflation's running at 4% than it is when inflation's running at 3%. So what we see the market pricing, and part of the real reason behind that yield curve inversion is this strong confidence in the market that the Fed's going to be able to get this back down to 2%.
It's always been there. It's amazing.
It's always,
really,
yes.
That's beautifully spoken because, John, that's the absolute underlying belief structure that we have.
Hasn't been shattered.
Hasn't been shattered. You look at five-year break evens, they've been pretty consistently priced at the Fed's target throughout this whole inflationary episode.
That's the credibility test for Chairman Powell. In fact, he's basically said a few times. Can we finish on the global backdrop? We haven't discussed that much. Does it matter to your call that China's experiencing what some people might refer to as deflation, disinflation? The UK's got problems with inflation, Europe inflation. There's all this tension abroad in some major trading partners. How important is that?
So I think it's definitely important, John. And when we think about the China story, right, what that will probably weigh more so in when we're thinking about what our inflation forecasts are to the commodity story, right? And we've been able to see, and that's a major reason why year-over-year inflation's been able to fall so much, because commodity prices have fallen from where we were sitting this time last year. So the fact that we're seeing more of this weaker China story really does, I think, endorse the fact that the market's been able to price inflation down so much. When you're talking about how the market prices inflation, it's very, very highly correlated to the commodity story. So that in and of itself really does help support lower inflation compensation priced across the curve.
Megan, thank you. Big fan of your work together with Mark Urbano. Just brilliant. Thank you. Thank you very much. Thank you. Megan Swiber there of Bank of America on rate strategy and this inflation backdrop. Some encouraging numbers so far this week. Big debate is whether that continues beyond the summer. Megan thinks it might be able to. Others do too. Then you've got Andrew Hollenhorst pushing back, still looking for a hike beyond July and looking for another one potentially, Lisa, in November.
There's a tension if you have Jamie Dimon coming out and saying the consumer is still strong, they're still spending, the economy is still going forward, people are making a lot of money based on higher interest, to then saying that the disinflation will just continue and the year-over-year comps will still allow that to happen. And that is the tension.
JP Morgan up 3% in the pre-market. If you are just tuning in, welcome to the program. The S&P 500 with a lift as well. We're positive here by 0.08%. Outside of that, take a look at the FX market. Just about positive on the euro against the dollar. Euro dollar 112.27. 7 consecutive days of this. If we close here, positive on the session on that currency pair, Tom. Longest streak since July 2020. That long.
Yeah, I agree. The persistency of the streak's a big deal. As I alluded earlier to the great Stephen Englander, John, and I think it's going to be a constant theme, is to move from currency pair analysis to index analysis to trade-weighted analysis. A full disclosure, on a Friday, folks, I haven't done the work. But the answer is, if you look at 5, 6, 7 major IMF trade-weighted series, I think you're going to get a real story there about the tensions as we enjoy a Trumpian weak dollar, the former president screaming we needed a weak dollar. But what's the impact on strong euro, strong Sing dollar, strong yen?
112 isn't it yet. Let's be clear about that.
I would guess that.
On the euro. It's not parity, I know that, and everything's relative, but 112, I think we're still just about okay. City earnings coming up in around about 17 minutes. So this is what we'll do. We'll break the numbers for you. Then we're going to get some reaction from Ken Leon of CFRA on those City results very shortly. Sonali Basset's going to drop by as well, Tom, and go through those numbers too.
What are you going to read in on this weekend?
Credit quality.
I'm looking at David Ricardo. I got a week till Budapest, till Hungary. And to see Ricardo driving, I'm going to read in on that.
Okay, David.
What's it called? Tasso Rosso?
David?
Yeah, you know. Okay. He was a great economist. He was named after the Economist.
You think he drives an AlphaTauri now?
Whatever he drives. He's got some new car. Ricardo was named after David Ricardo, the Scottish economist.
No one knew.
Yes,
I don't think Daniel knew either. Equities, positive. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself
self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
There's clearly been a tremendous demand for bonds. I think a lot of it is there's a tremendous amount of liquidity out there still. I think the bonds are okay, and I think stocks still have upside, especially in the laggards like financials and industrials.
Ed Yardeni, bullish, still bullish. Of Yardeni Research, the president there, weighing in on this equity market. Futures at the moment slightly positive on the S&P 500 by 0.1%. The numbers out of the banks pretty decent this morning. Let's check them out. JP Morgan, Wells Fargo, Citi coming up next. JP beating a raise. Wells, it's basically the same thing. JP Morgan in the pre-market up by 2.8% this morning, Tom. Wells Fargo up by 3. Citi, after having a look at those numbers, investors bidding that one up by 1.85%.
I think most of our audience, including Global Wall Street, knows each of these banks have a character. There's a culture to them that goes from mergers and acquisitions, how Bank of America, John, was pieced together out of 47 banks. Brian Moynihan is a young lad having a lot to do with that on the Northeast coast, and on and on. And there'll be a discussion Monday, Tuesday. On Wednesday, there's not going to be any discussion but the future of the house that Weinberg built. And I really think it's going to be really key, the messaging of Goldman Sachs and how it's taken on Wednesday.
And David Solomon. The bar's been set so low, Tom. So low.
And there's a heated, I'm going to cut right to the chase. There's a crew that says this guy's been tarred and feathered. Lloyd Blankfein screwed this up. David Solomon didn't. That's the heart of the matter. And I just don't, I think Wednesday's maybe more important than we think.
At some point you own it though, Tom?
Yes. Oh, yeah. Oh, yeah. I don't have an opinion on this. I adore Mr. Blankfein, but the bottom line is that's the zeitgeist out there from a certain group. And we'll have to see. I mean, that's all there is to it. Futures have improved. JP Morgan alone has lifted futures. Someone who's long on this is Srinath Rajan. He is expert on this for Bloomberg News and doing two things. The zeitgeist of this, yes, but also the reporting. What is the immediate reporting of the future of the leadership of Goldman Sachs?
Well, for one, let's look at what JP Morgan posted today. And when you have a bank that's already up 11% this year, the stock's up 11% and goes out there and posts an ROE of 20% and the stock bounces another 3% on top of it, that doesn't set a low bar, that sets a high bar for others to follow. And that is something that will make bankers inside Goldman Sachs sweat today, because they have telegraphed, they have made clear that the numbers that they are going to post are going to be pretty bad. ROE will be in the low single digits. It's not going to look pretty. They will obviously have to play the game of telling investors and analysts not to look here, but look there. Don't look at Q2. It's 2 weeks in the past.
Right.
Look at what's ahead. And it's remains to be seen if they can sell the market on that.
There's all these rumors out there, which I'm not expert on. What's the train wreck moment here on Marcus? When do they fix Marcus? That's what the street wants.
Look, we're 9 months into it. They swore by it. They committed to it. They wanted to get big in it. But they also made a 180. They've made a complete about turn there. They've pretty much shed most of the important ways in which they tried to court Main Street, Marcus lending, all their direct-to-consumer push. Outside of that successful high-yield savings account, they're pretty much out of it. There's even questions over the future of their partnership with Apple and GM. So it's not going to be a part of the conversation cycle a few quarters down the line, but it still might take up some airtime right now.
Sri, you wrote about this earlier this week. How rare is it for the likes of Goldman to come out and set the bar so low?
It's interesting when you talk to all the analysts from Mike Mayo to David Conrad to everyone else, they don't normally do this. Goldman is famously reticent about providing any sort of intra-quarter guidance. Yet this time they've gone out there and talked about the 25% slowdown in trading. They've talked about some very specific hits that they're going to get in the real estate market and about the write-down they're going to take from the Green Sky acquisition, which, by the way, was an acquisition they only completed a year ago and are already trying to sell it off. For a firm that's run by expert investment bankers, it's never really been good at doing acquisitions. But here's the bigger issue. Have they been able to drive down consensus estimates low enough? Because it's clear from all the body language, it's clear from what they've said publicly and from what we hear from investors and analysts who've been talking to them privately, that they're really trying to drive down expectations. Is it a case of under-promise and over-deliver, or the more worrying scenario of under-promise and under-deliver?
Sri, you said that it was going to be a quarter of saying, don't look at this, look at this. What are they going to say, look at this? I mean, where is the sort of growth that they're going to point to that could come in the future?
Green shoots, the favorite term for every investment banker in the last few weeks. They will talk about how this might be the trough for investment banking the last few quarters. After the boom that we saw through much of 2021, investment banking has been sliding down. They're hoping Q2 is the trough. Capital markets, hopefully, maybe opening up. If, with all the numbers we've seen this week.
This is I'm going to interrupt you. This is really important. They're hopefully. I don't hear these other banks hopefully. They're not hoping. They have a strategy, a plan. The ratios of asset and wealth management for J.P. Morgan is an act of God. Goldman Sachs has an equivalency to Mary Erdős's fiefdom. Does Goldman Sachs going to have those kind of numbers in asset management?
The problem is, again, they have this historical reliance on using their principal, using their balance sheet to make investments. And now this quarter, they're going to see big hits on that. So they will slice and dice. They will try and tell you, ignore the losses that we have from our balance sheet. But if you look at our fee-based revenue, look at the durable growth there, they will try and sell that story. And there is a reason that they have to lean in on hope, Tom, because the other banks can point to a 20% ROE. You just can't go out there and flaunt a 5% ROE and say, this is why you need to believe in the stock. That is why they have to paint a more rosier picture for what lies ahead.
Are they done with layoffs?
They will not say that. We've had James Gorman was very specifically asked, are you done with layoffs? And he said, look, we just went through a round of 3,500 job cuts. Many managing directors in that rank. We don't think we'll have a reason for more layoffs. Goldman isn't committing and realize that they've already done 3 rounds of job cuts in the last 12 months. They realize that if the markets don't rebound as quickly as they would like to see, they may have to take more actions because expenses is one thing that they can control if their underlying business is not going on all cylinders.
Goldman Sachs coming up on Wednesday, coming up in about 7 minutes' time. So we finish on this 3. Citi. What are you and the team looking for from Citi in a moment?
It's a bank under transition under Jane Fraser. Again, don't care so much about the investment bank. They're growing their transaction banking business. That remains a focus. That corporate bank, their relations across the world, and of course how they're shedding all their assets globally and focusing the bank in a way that will actually start to outperform, because the last 5 years have not been pretty for Citi.
Be honest, when these calls start, are you listening to them or watching Djokovic play?
That's exactly where I was going.
It depends whether it's before or after 8:30.
8:30 Eastern time.
Are you going to fly over
fact.
Wimbledon? I mean, you're such a tennis hound. Are you going to? You look like you're dressed for JFK to get over there for the.
The problem is John Farrow's country will not give me a visa. I don't have a visa to go over to the United Kingdom.
Do you need a visa to get into the UK?
Yes, that's the problem with an Indian passport.
That's
John.
ridiculous. There is no agreement for you to go on a tourist visa.
It's un-American.
From your lips to God's ears.
Wow. So you can't travel. Seriously, I wasn't aware of this. You can't travel from JFK to Heathrow on a tourist visa.
Oh, I need a tourist visa.
But how easy is that to access?
Not that easy.
That's insane. I wasn't aware of that.
That's a window. That's a window, John, into this world we live in.
Wow.
Yeah.
Sri, going to the US Open? later this summer?
No visa there, so that's easier. I just need to get on the 7 train.
I saw you there a few years ago at the same event. Sri, wonderful to catch up. Looking ahead to earnings. Thank you, sir. Sri Nandarajan there of Bloomberg. On the latest, looking out to Goldman coming up next Wednesday. Silly Tom coming up about 5 minutes.
I don't think you're going to hear hope from Jane. I think Jane's going to be chiseled. This is what we're doing. This is a plan. There's going to be none of this hopefulness stuff that Sri alludes to. We'll hear from Goldman Sachs.
You watching Novak later?
I'm
Alcaraz,
full
Danny
disclosure.
Medvedev.
I'm not into it. Am I going to be glued to it? No, but I
try out 10:30. Just watch a couple of games. Watch a couple of games of Alcaraz versus Danny Medvedev.
I will.
Just like the intensity of it.
Medvedev beat the American, right?
Yeah, just watch a few games of that, and just Tom, you'll be impressed. I think
that's
going to be that's going to be sticky viewing for you.
You know, I'm starting to steal up here for Budapest and David Ricciardo's comeback. I think I'm really excited about it.
What is the comparative advantage of AlphaTauri?
It is. It's a comparative advantage, and his Perez. I mean, the David Ricciardo against Perez is going to be something.
Let's see if we can get Checo's seat.
I'll let you explain it to me.
Not now. Ken Leon of CFRA coming up very shortly to break city earnings. Looking forward to that. We'll do that with Ken, and we're going to catch up with Shanali as well. From New York City with Equities Positive, this is Bloomberg.
Welcome back to another special Wimbledon update for Bloomberg TV and Radio. From Tennis Channel, I'm Erin Coscarelli. Marketa Vandrousova became the first unseeded player to reach the ladies' final in the Open era with a straight sets win over Alina Svitolina. The Czech star is looking for her maiden Grand Slam crown in London. She'll face last year's runner-up Ons Jabeur for the title after she edged Aryna Sabalenka to punch her ticket into her third career final at the majors.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
I still believe that we're trending toward a recession because of the labor market.
We're not going to have a economy-wide recession. I was of the view that we've been in a rolling recession.
Recession is not a guaranteed outcome, but it still looks very highly probable.
You're not going to get the rate cuts that we're expecting for 2024.
Will the Fed do another one and then pause? Likely.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It is an historic earnings day for the big banks, and we move on that into a true bull market. Futures, James Dimon lifts futures up 5, down futures up 147. But right now, the starkest of moments is Citigroup coming out. John, we're going to go into this in a moment with Ken Leon. Back to 2007. July, before the crisis of the 3rd week of August of 2007. Since then, JP Morgan per year up 11% per year. Citigroup per year down 11% per year, and that's the massive divide between Dimon and Fraser.
Jane Fraser over at Citi trying to address those things. Citi right now in the pre-market up by 3%. Here are the headlines. Fixed sales and trading revenue for the second quarter comes in at $4.45 billion US dollars. The estimate $3.51 billion. Second quarter EPS in at 133. They're the headlines I can see on my screen. Digging through the release, Shonali Basak alongside us around the table. Hey, Shonali.
Listen, if you take a look at what Citigroup is posting, they're bringing in revenue just above expectations. Very sorry.
It's okay, you're sitting next to me, so it's you're allowed to do that.
Listen, fixed income trading revenue coming in that high is pretty stellar for Citigroup. What it is showing you here is Jane Fraser is investing. They're investing in those institutional businesses and punching on all fronts when it comes to that business. When you look at the first thing they tell you is that they've returned $2 billion to shareholders in the form of dividends and repurchases. Why does that matter for Citigroup? Because we're concerned about their stress capital buffer in the wake of these stress tests. You've already heard JP Morgan, Jamie Dimon, talk about higher regulation. We'll hear the same when it comes to Citigroup. We are going to be looking for costs at Citigroup as well as we continue to look at what's happening here. Their total cost of credit is actually lower than the prior quarter. So again, like the other banks, not as bad as things could possibly be out there, but other costs. Remember, Citigroup has started to lay people off as well. We'll be continuing to look at what they say about severance costs for the look ahead, because we've already seen Wells Fargo increase their costs for the quarter.
Citi with better numbers. Tom on FIC. Let's get some more numbers. Investment banking revenue, $774 million US dollars. The estimate, TK, 671.
The second page on the deck of 39 pages is just simple. They talk about culture and talent, strategic execution, transformation. And to me, the major headline here, among pretty good numbers and a positive day for the big banks as general, no other institution in Manhattan is under a transformation like Citigroup. Nothing's equivalent to what we see here with Citigroup.
Bit of commentary from Jane Fraser, the CEO. We continue making progress in executing strategy. Shonali, if you could, we'd love you to. Can you summarize what is the strategy of Jane Fraser and how it's different to what came before with Corbett?
Very quickly, we have Jane Fraser exiting certain markets here, and we're seeing the last of that coming with Banamex as well. That'll take some time, but it's announced, and we're getting there. So we have the first phase really getting to the end for Jane Fraser. We also see her doubling down on wealth management. There's been changes in leadership at that business. To Tom's point all morning, asset, wealth management, this is the money business on Wall Street these days. Citigroup's advantage here is that they are very global already. That is not what you see over at Morgan Stanley. You have Credit Suisse shrinking across the globe, and so Citigroup in particular would be a beneficiary of this, given they already had that global footprint.
One quick question I want to get to Ken Lee on. What's so important to me, Sonali, is what Srinatarajan just said, is Goldman Sachs on Wednesday is surrounded by hope. Does Citigroup have the same desperation of we're hoping this occurs, we're hoping that occurs, or is this a more stable enterprise forward?
You're looking at two different banks. You have Citigroup trading at about half of its book value as of this morning. So they really, what you would hope, they have nowhere to go but up at that level. For Goldman Sachs, if you look at the peer group here, their returns on equity that are expected are lower than almost everybody, lower than even Wells Fargo. So next week is going to be a tough week for the investment banks after you saw such a big lift for the investment banks. $4.5 billion in fixed income trading at Citigroup is nothing to cry home about. That number is supposed to be pressured at Goldman Sachs.
Sonali Basak, she'll dive into this and give us some great detail on 39 pages of Citigroup PowerPoint. Joining us right now and continuing to support us is Ken Leon, Director of Equity Research at CFRA. Ken, I highlighted at the beginning the mass polarity between JP Morgan and Citigroup. Is Citigroup a big bank?
Citigroup is an enormous bank. And Jane Fraser has a journey. She's on the right course, but it's in years and not in months. And she would prefer to underpromise and overdeliver. That narrative changes because we've gone through event-driven selling the non-consumer banks. Banamex was a disappointment because there wasn't a buyer. So by 2025, they're going to take it public. But it's going to be operational. And Tom, the conversation that we had during the Corbett years and now with Jane Fraser is heavy investment in technology platform, compliance and regulation. That should begin to improve margins for the business as investors focus on operating performance in 2024. But again, this story is in years, not months. So it's kind of still in the first half of the game, kind of like where we were with Wells Fargo back a few years ago.
Citi reaffirming its full-year revenue forecast in a number of slides. We've seen reaffirmation and an upgrade from the likes of JP Morgan. As you get the initial results, what are the themes that stick out and who's executing the best?
It depends on what area, but you know, when you say who is firing on all cylinders, it's JP Morgan Chase. It's just incredible. And it's really was spearheaded with the Investor Day a few months ago, showing the depth of their management, their strategic plans, and their ability to drive higher return on equity and return of capital. It's just been incredible. So they've actually moved a few polls ahead of the peer group.
Given the fact that the other banks are trying to compete with that, Citigroup's strategy coming out, its expenses are about where they had previously thought. FICC came in almost $1 billion above the revenues that they were expecting, Ken. How much is this upgrading the image of Citigroup in your mind to something that does have a more optimistic trajectory?
I think Citigroup's on the right course, but investors have been burnt waiting for Godot. In essence of a full turnaround. Jane Fraser has the right strategy. She needs time. And to Sonali's point, when you're trading at such a low price to net tangible book value, there's opportunity. So the question is, this is an attractive value or it's a value trap? We think it's more promising, but we still have a whole rating on Citigroup.
Tell me about wealth management. We're gaga over the JP Morgan numbers. Of course, James Gorman at Morgan Stanley acclaimed for his success. Maybe as a generalization, Goldman Sachs struggling. To me, Citigroup Wealth Management is an enigma. Can she compete?
She can, and she's has a strategic plan and new leaders. The strength of Citi Wealth Management really has come from Asia, where they are one of the top 3 players that are from the U.S. But in North America, really, it's going to be trying to scale up against the dominant players of Bank of America and Morgan Stanley. But they see opportunity, and their CFOs are telling Citigroup that, of course, if you want to get a higher multiple for your stock, you need more businesses that have recurring revenue and attractive fee income. Because you can't always play the net interest income rate game all the time.
I mean, John, to me, this is just absolutely germane and maybe of immediate time. We're talking about, again, Goldman Sachs hoping here. How do you hope to compete with a juggernaut like JP Morgan, where clearly people are throwing money at them? In the PowerPoint, I don't see that people are throwing money internationally at Citigroup. I could be wrong on that, but that's what I observe.
Goldman Sachs, of course, is not Citi, it's not Wells Fargo, it's not JP Morgan. Everyone, to Tom's point, has their own identity. Are there points of these releases this morning, though, that might give you some encouragement on certain parts of the business at Goldman to next week?
So again, they're not small. They are a very top 5 player in asset management, wealth management. They're way behind, and it's a different business. So I think that's going to be the bright spot, along with areas of transaction services. But then again, it's the optics and the body language from David Solomon, to the point that we do have a strategy. We did outperform the S&P 500 since I took over. Only 2 or 3% of the stock is owned by partners, and I'm serving institutional or public investors. And we're moving on the right course, and we're going to gain wallet share. And they will gain wallet share in the next 12 to 18 months in trading and investment banking. But that's kind of where we were, and we then went off the page with some of these adventures into consumer areas that they have to write down.
Ken, do you expect to see dispersion where JP Morgan doesn't have to pay for deposits and Citigroup and other big banks have to pay a lot more?
Lisa, everybody has to pay for deposits. And even my mother knows that she can get a 5% yield. So, I mean, those days are over. That was a decade of free money or low rate money. And it's just part of the business. But again, what drives net interest income and net revenue is loan volume. So we have a stable or healthy economy, even with rates and some deposit spreads narrowing. It's a pretty good picture for banks.
Ken, wonderful to get your perspective. It always is on earnings season. Just to hear from the likes of Gerard Cassidy of RBC, Ken Leon of CFRA. Ken's going to be with us a few times, I think, over the next week as we work through these bank earnings. So that's it for this morning from the likes of Citi, Wells Fargo, JP Morgan. Now it's on to next week. And so far, so good this earnings season. Take the banks, take Delta, the airlines here in the United States, throw in PepsiCo. Earnings season's been pretty good so far, Tom, in the last 24 hours.
There's been I can't wait. I think we have Gina Martin-Adams coming on the backside here and to talk equity strategy, frankly, through next week as well. And it's just simple. Are we just going to see continued multiple expansion? I mean, I just, does the multiple on JP Morgan expand?
That's also been a criticism of this rally so far this year, that a lot of it, Lisa,
by the people not in the rally,
has been multiples, precisely by the people who weren't in this rally.
Based on the earnings, the revenues are starting to catch up. The earnings are starting to catch up, and that's what people are watching, with really the economy continuing to chug along, and that is really the theme we're hearing from these earnings.
Equities right now up by 0.2%. Coming up very shortly, Parag Garvey of ING Financial. Looking forward to that. If you are just tuning in, welcome to the program. Stocks are positive, as I said, by 0.2%. Coming up very shortly, we'll have a conversation on interest rates and the Federal Reserve. The latest from Andrew Hollenhorst, dropping their call for a hike in September, pushing that out potentially to November. They think, Tom, there is the potential here for inflation to pick back up again after a soft patch in September.
Well, that was a fan distribution chart from Michael Gapin and the others at Bank of America, like 5, 6, 7 outcomes you get on an inflation path. And I think that basically the headlines that we've had imply a linear function of disinflation, and the pros are not doing that. Some are looking for lower inflation, disinflation. Some are looking for stability, but there is a growing crew saying, okay, at some point we get to where we are, and then maybe we tick up.
I just want to bring you this. It kind of dovetails this idea of interest rates into the earnings. This from Citigroup, that they had 11% jump in revenue from U.S. personal banking led by credit card balances, which helped offset the 78% surge in write-offs tied to consumer loans. This the theme that a lot of banks are increasing their loans even as they see a weakening in the credit profile because they are earning so much on said loans.
To it. It's a drug.
This is a fascinating tension when you start levering up in the heels, in the face of weakness.
What are you making on those charge cards? 20%? Did they do that in the United Kingdom, John?
What's that, Tom?
20% interest rate on a charge
credit cards?
Yeah.
22%?
They're sky high.
They're sky high in England too.
Yeah, credit
That's
card
like
fees.
biblical. I mean, come
Interest
on.
rates on credit cards are nuts, yeah.
When we were in school, nobody talked about 24% charge cards. They're ridiculous.
Not everyone can play the points game where you just spend on your card to get the points and then pay
What's
it
the
off at the end
point?
of the
You know,
month.
which island do you want
Not
to go
everyone
to
can do
next
that.
I
weekend?
didn't have a credit card when I was in college, but you know.
I didn't either.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We are on track for a soft landing. And I know, the bearish camp would say, well, you look at positioning and it's getting very exuberant, by some metrics. You look at, whether it's hedge funds, whether it's CTAs, all of those investors have, very quickly, very bullishly positioned. So, that leaves you susceptible to a negative catalyst. But can you name a negative catalyst right now?
That was Anastasia Amoroso, Chief Investment Strategist at iCapital, summing up the decent news we've had so far this week, encouraging a market rally, but potentially a fifth consecutive session. Your equity market right now on the S&P 500, slightly positive by 0.2%. Doing okay. Let's check out the banks, the financials, those that have reported so far. Citi, Wells Fargo, JP Morgan, and have a look at where they're trading. JP Morgan is up by 2.7%, Wells up by 4.5%, Citi up by 0.9%. Just a bit of a correction on Citi. Their fixed income sales and trading revenue number coming in at $3.53 billion. That is against the estimate of 3.51. Investment banking revenue, $612 million against an estimate of 671. A bit of a correction on those two lines in the last couple of moments. That stock, Tom, still positive for now in the pre-market.
We'll bring you more on those corrections as we fade through it, as we wade through it, I should say, this morning as well. I do want to mention the market's up 7, SPX up 7 points on futures, the VIX stable 13.68. This is the conversation of the day for people looking for stability of thought on the rate market and how it folds over to the Fed. Park Harvey is head of global debt and rates at ING Financial, and he writes these absolutely brilliant, what I call collar notes, where he sets up ranges around a 10-year, ranges around a 2-year. How have you changed your collar guesses given the glory of what we saw 2 days ago?
Yeah, it's been an astonishing week, Tom. I love that 0.2% inflation number. Annualizes, it's up 3%. We need to keep that up. 0.1% PPI annualizes to below 2%. We need to keep that up. it's rationalized this move back below 4% for the 10-year. That's key, because when the 10-year got to 4%, it looked really comfortable there, really comfortable, because the labor market's been so strong. So we've got this pulled down. The big question now is, how far can the 10-year fall? And if you know nothing else about bond markets, the way you model the 10-year is you look at the Fed funds strip, you take it out 2 or 3 years, and you ask yourself, okay, what's that rate? And you add 30 basis points to it. So what's that rate today? Around 3.7. Add 30, 4%. So what that tells me is that there isn't a huge room to the downside here. Now, the question is, why is that long-term Fed funds rate so high? Because it was down to 3%, the labor market. The strength of the labor market is preventing rates from really gapping down here. And that's really crucial.
If you have weak dollar and you have some form of implied felt a good hope and feeling of wealth creation internationally, at the margin, they've got to buy full faith and credit U.S. paper, right? Isn't that help price up, yield down?
Absolutely. I mean, if you look at the demand for treasuries over the past 3 or 4 weeks, it's been phenomenal. We had auctions this week which were...
Lisa told me repeatedly.
Yeah, 10s and 30s tailed a tad, but there's been good demand for duration, good buying. I would suggest that's prevented the 10-year yield from really gapping dramatically above 4%. But I mean, to go back to your original question, Tom, if we're talking about ranges here, I would still think that the range for the 10-year is 3 to 4%. There isn't a good rationale for breaking dramatically above 4%. We can go above, but to really break dramatically above, I don't see it. And I also don't see a good reason to get below 3. And right now, I think there's great difficulty in that 10-year really gapping down here, unless something changes. I mean, if you give me a negative payrolls outcome, okay, that changes the game. But give me that first.
We're speaking with Park Garvey of ING Financial as we get some of the earnings from the biggest banks, including JP Morgan, Citigroup, and Wells Fargo. JP Morgan reporting record revenues, all of the bank executives coming out and saying they see strength, albeit they're building some of their credit provisions. Is there an uncomfortable and unreconcilable tension right now between the strength that we're hearing about from Jamie Dimon and this sort of recessionista feeling that you're seeing in a 10-year with people piling into the long end and expecting gains there?
Right. And you see that in the data, Lisa. I mean, the labor market is consistent with what JP is saying about the economy, which is resilient, and we would fully agree with that. You look at the survey information, it tells you something very different. Small business sentiment is on the floor, CEO confidence on the floor, manufacturing PMI on the floor. So all of that has traditionally anticipated a recession. But then you look at services ISM fighting back, housing market fighting back, consumer confidence fighting back. June has been a remarkable month. And interestingly enough, one of the catalysts for the positive June was the banking crisis, the mini banking crisis we had in March. SVB goes down, rates collapse, the rate discount collapses as well. Risk assets love it. Once they feel secure about the banking story, and it took us about 6 weeks, we went risk on.
You say that you expect this collar of 3 to 4% for the 10-year. Does this suggest that you think that this tension isn't going away, that the disinflationary push that everyone's buying into now is not going to be resolved so cleanly, and that we're going to be toying with this idea of sticky inflation for a longer period of time for several years?
Several years. Tough one. I would say certainly for the next number of quarters. We feel quietly confident that by 2024, we're not going to be worrying about inflation. I mean, unless you're going to give me a shock that I don't know about. But by the time we get to that period, we should be in decent condition. Why is that? Demand is beginning to wane. This impact of higher rates and higher inflation will ultimately have an impact on the economy. The external influence is quite weak. China weak, Eurozone technically in recession. All of that is manifesting in a lower inflationary impulse in 2024. So the next couple of quarters will be tough. I mean, the odds are we will get a re-rise in headline inflation over the next couple of months. But by the end of the year, we're expecting core inflation to be below 3% and headline inflation to also be below 3%. So quietly confident there.
What's your Fed call? Have you changed it?
Recently, no. Have we changed it ever? Absolutely, we have. July, 25 basis point hike, and we think that's it.
Done after July.
Done after July. I mean, there's an argument as to whether the Fed needs to go in July at all. But look, the Fed have effectively told us they'll go in July. The market is discounting it. They will deliver a July hike. That really should be it. And
don't expect a repeat of that January news conference. I think it was January, early 2023. Disinflationary process has started. Do you expect him to start talking like that?
No. The Fed has a definite hawkish rhetoric mandate ahead of it. Even if July is the last hike, they've got to keep the pressure on. So we won't know until the September meeting whether July was the peak. And arguably, we won't know until the November meeting because they skipped in June. So they could skip and SEP and go in November. So the Fed will keep the hawkish rhetoric up right through to November. And it'll be the end of the year before we know whether they actually hiked in July.
And whether this soft patch in inflation can continue, persist through the rest of this year. Great, as always, Parag Garvey there of ING Financial on the Federal Reserve. On policy, on the data this week, and a little bit on bank earnings as well. Coming up in the next hour, awesome lineup. Mohammed Al-Erin of Queen's College, Cambridge, weighing in on what we've learned this week in financial markets and the global economy. Laurie Calvasina upgrading her earnings forecast on the S&P 500, upgrading the banks as well, so that's timely. Andrew Sliman, bullish for most of this year, still bullish over at Morgan Stanley. Jay Poloski of TPW alongside him as well. Looking forward to that. And David George, I believe, joining us around the opening bell to break down some of these banks from Bed Research. Hopefully that's enough for you in the next hour on Bloomberg TV. From New York City, equities up by 0.15%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg surveillance, I think we need a market check, and of course that's a bank market check here on a very, very interesting Friday as we stagger to Tuesday and Wednesday next week. Sonali Basic's going to be with us here in a bit, sort of summarize the theater of the day and the drama of next week. Is well, Lisa, I'm not sure I expected these numbers. Up 3%, up 3.9%, up 1.8% for CitiDog. I just did not expect it.
Well, they have mixed earnings across the board. They're in the middle of some sort of revamp. I'm still struck by what we saw from JP Morgan, another record, increasing expectations for net interest income. Those shares flying, a similar kind of dynamic with Wells Fargo, with the net interest income also very much in focus, expected to be up 14% year over year by the end of this year versus the 10% that it previously expected. The big takeaways. Number one, the economy is still strong. Number two, consumers are still spending, albeit perhaps at a slowing pace. And C, we have a situation where banks are willing to lend on an increasing basis, even if they have to increase their loan loss reserves, because they're making so much money on the other end.
I think the credit dynamics we're studying, I'm not going to do it, but what I'm really focused on here is almost like the idea of people throwing money at money market funds. People are throwing money at JP Morgan. That's where I want to go with Sonali here in a bit. Let's do this. John Farrell preparing for the next hour. Dr. Ilarian will darken the door here, no doubt, to talk about Queen Park's Rangers. Futures up 8. They advanced through the morning. Dow up 169 points. I'm not in the 35,000 watch on the Dow, but boy, are we getting there quickly. What we need now is a reset on the American economy. She's expert with this, with the acuity out of London School of Economics. Pooja Sriram joins us now, U.S. economist at Barclays. You got to write a weekend note, my deepest sympathies. What's going to be the theme of the weekend note across the algebra of real GDP? Consumer, investment, government, and this oddity of trade.
Yeah, that's a good point. So, you know, we've been seeing very strong consumption spending since the beginning of this year. Like, you know, Lisa pointed out, there are signs that perhaps the momentum is slowing, but we're still, you know, fairly high. So just to give you a sense of the numbers, you know, we're tracking GDP in the second quarter at still 1.5%, close to 1.5%, and that's a resilient economy. I think where we are seeing some signs of weakness is perhaps in business fixed investment, and that's, you know, supplemented by the data we're getting in terms of manufacturing PMIs, and that's really where the weakness seems to be building up. And then we're expecting, you know, some drag from trade. But overall, if I were to look at GDP, you know, we're still on a fairly strong footing.
It's been off message today for us as we focus on the banks, and it really hasn't come up in the PowerPoints that I've seen. But what does Barclays, with all of your heritage of studying this in London, say about commercial real estate? I understand it's not going to move the needle on real GDP, but fold a commercial real estate analysis into your American economics.
Yeah, fair. So we did write about this a while back, Tom, and we, of course, focused on office CRE, and I think that's where, at the time, there was a lot of discussion about stresses. But, you know, some of the takeaways from the note was, look, office CRE is just about 1/3 of all of the CRE in the markets. And I think the second is it really depends on, you know, how the stresses play out. Typically, you find that loan maturities are staggered, lease rollovers are staggered, and a lot of exposure for CREs is with the smaller banks. So for it to become a macro scenario, we would really need a solid meltdown, and that's something we don't see happening at the moment.
Pooja, we're talking about the economic backdrop in a week that has been pivotal. It has given us both the disinflation narrative that has given a steroidal shot, and everyone seems to be buying it. It's everything is rallying kind of week. We also have earnings from a number of companies, not just the banks, that highlight the strength of the consumer. Is this an economy that has any chance of a recession this year?
Well, at the look of it, yes, it seems hard to see how the slowdown materializes. But our baseline, Lisa, is that it's likely that momentum will slow towards the end of this year. And a lot of that is contingent on the Fed's hawkish rhetoric and further rate tightening. And, you know, it's hard for us sitting here to now think of how the economy slows. But we think higher rates will slowly start to bite towards the third quarter of this year. We're seeing some nascent signs of slowing, perhaps, in the economy. And we think that with further rate tightening, we should get to a point where we see a mild and shallow recession towards the end of the year.
We're seeing that a lot of the banks are increasing their loans to consumers right now. They see the money signs because they're getting good interest rates on these loans, even as delinquency rates pick up and they're putting aside more cash for loan losses. How do you watch this, the re-leveraging of the American consumer ahead of what a lot of people are expecting to be a slowdown?
Yeah, that's a good point. So we are seeing some signs of stresses in terms of delinquencies, like you pointed out. And we think, eventually the U.S. consumer is likely to slow. But, just to sort of tie all of this back, it really depends on what happens to the labor markets. We're seeing strong consumption spending. That's primarily a reinforcing cycle of strong labor demand, feeding into income, feeding into consumption. So in order for this to slow, what we really need is for labor market conditions to ease. I think that's the key point that we want to see, and I think that's where we're looking at in terms of where consumption spending is headed.
What I see in the earnings, we'll talk to Sonali Basak about this in a bit, folks, and then Gina Martin Adams on this equity surge, and I want to fold this into economics because everybody's telling me hour after hour after hour in the zeitgeist now that the stock market's delinked from the economy, which I'm not sure I buy. What I see here in the PowerPoint from JP Morgan is the iconic bank is the rich people are basically throwing money at a financial system, profiting from it, and the haves in America are really doing well. What's a polarity? I think you're really qualified to do this with your work out of India and out of the United Kingdom. You're distant from this, which is great. What's the polarity you perceive in the two Americas or the three Americas that are out there?
Yeah, I think that's a good point. I think that the people in the upper income group are clearly very well positioned in this economy. Very strong balance sheets, very strong savings, and I think it's perhaps the income percentiles which are in the lower end of the spectrum, which is where the stresses are likely to be felt. Of course, we look at aggregate data, Tom, and what that tells us is across the board, people seem to be comfortable to not save. Even in this economy, I think, and that they're benefiting from this huge pile of savings, and they're taking comfort from it. And so across the spectrum, it seems like, we're yet to see any cautious sentiment set in.
That's the expensive summer camps in plural, which is where you see the saving dynamic on a macro basis slip away.
Roll over.
I'm hoping July rolls over into August where we can save ourselves. Pooja Sriram, thank you so much. With Barclays with a really nice update. And the weekend reading on this, I think, is going to be fascinating. The process of notes coming out after this week.
The Great Reset, the disinflationary pulse that everybody was seeming to buy into this week, and then what this means about soft landing, how much everyone just pushes out recession until never, or 2025, or who knows when.
She sends notes out. What you don't see from Sonali Basak off camera is she's working away, diving into what, Lisa, 40 pages for each bank, and coming up with summary notes. Is this a celebration today, Sonali Basak, of the prosperity of the haves in America? Is this just a boom economy for the kind of people that actually speak to JP Morgan?
There's a number we haven't talked about yet, Tom, today, and it's this idea that JP Morgan bringing in $87 billion in net interest income for the year. That is comfortably more than JP Morgan has ever brought in before. And to the point that Lisa's making, this idea that charge-offs are coming back, but not at the same rate. If you look at the biggest banks in America, if you look at the total Federal Reserve data, charge-offs are kind of normalizing here, and it's what JP Morgan is telling people, that it's a normalization, not a deterioration. But if you look at the data from the Federal Reserve outside of the top 100 commercial banks, that charge-off rate is meaningfully higher. It is more than 7%. It is easily the highest level we've seen since the financial crisis by a landslide. And so you're not seeing the same thing across all the banking system, and JP Morgan is consistently coming out as the biggest beneficiary.
How much is the net interest income boon that we're seeing pretty much across Wall Street tied to the increase in loans to consumers, to businesses, versus just the deposits that they don't have to pay anything for? They pay 1% and they can cash in on the short-term rate side at 5%, 4.5%.
Yeah, it's interesting. You hear JP Morgan talking about this as well. Why haven't they raised rates? Because they're not deposit chasing. They're flush with deposits. They don't need that many more of them. And we have seen that natural flight to safety anyways in the last couple of months. So the point that you're making here is that's not the same picture for the regional banks that we're going to hear from next week that are going to have a lot of pressures. If you also look at the lag in the data, I think it's fascinating. If you look, there's this beautiful chart in Wells Fargo's own release here that shows you the drop-off in mortgages relative to the other types of loans that people are taking on. And mortgages is really where you see a lot of that problem. When you look at commercial real estate, when you look at the single-family mortgages as well, there's an expectation that the delays you're going to see are pretty significant, that the pressure you're going to see there is over quarters and potentially years. Something interesting, you keep on talking about Goldman Sachs. One thing we also haven't talked about is this idea that Goldman might take a $2 billion hit tied to some of its credit products and commercial real estate as well. So they might be a bellwether there when you take a look at what else you might see in terms of pain, again, not just for a Wells Fargo or Goldman, but the regional banking system as well.
Shahid Bassick, thank you so much. Somehow Tuesday, Wednesday of next week, we'll see you again. We got who? Morgan Stanley, Goldman Sachs, Bank of America.
Yep, not in that order.
First National Bank of Bramo will be out with.
The regionals as well, yes. Not necessarily that one.
But actually they matter. Don't we agree that what Pacific West says this time around matters?
I would agree, because how much are they really retrenching their lending? And you can say that perhaps that people just want to go to lunch, but they provide much more lending than their footprint would suggest in the American economy.
Right now, Lisa and I are going to do this, and this happens, folks, and I have had this done to me where I have made a mistake, and Bloomberg has a heritage with the leadership of Matt Winkler of making corrections. Robert Lavelle does the heavy lifting here, Lisa, and off of Citigroup, still nicely elevated off of the previous $47.68. The FIC area, there was a correction there. The investment banking revenue, return on average equity, return on average tangible common equity. So be careful the sources you see today. Futures up 5, Dow futures up 153, the VIX 13.72.
If you're just joining us, we're looking at the bank earnings today that are really important to get a gauge on the U.S. consumer, on the U.S. economy. And the read, Tom, has been pretty much across the board. Things are going really well still. And for the banks, that means a record revenue at JP Morgan. They are, of course, talking about how some of the regulation is overstepping. We're hearing that already from Jamie Dimon. But more importantly, how long can this dynamic continue? If you do have consumers strong, lending is continuing to increase, but those delinquencies and those write-offs also continue to tick higher.
My most important interview now, I know, Mr. Dimon, you listen religiously to the program. I don't want to talk to Jamie Dimon. I don't want to talk to David Pinto. Maybe I want to talk to James Gorman. I want to talk to Mary at JP Morgan. And I don't think there's been nearly enough credit done here, what they've done. And I think what we're going to hear from her behaviorally is in the last 6-month crisis, we are now at a point where, and I'm saying this is a complete uninformed amateur, people are throwing money at JP Morgan. I think that's the behavioral construct here that gets you to a 35% return on equity. That number's crazy.
We just heard that from Shanali. People want to give their money to JP Morgan. They don't want to attract more deposits, so they don't need to pay. And that's something that is going to be a very different story next week when we hear from the regional banks, where they are offering other products, short-term instruments,
and money market
with 5.5% rates. Yeah, that's different from what you're seeing at some of the biggest banks.
Very interesting. We will continue here again with futures up 6, Dow futures up 156. A lot of interest in the market. Dollar weaker is a headline story today. Lisa Bramwitz and Tom Key, we're going to continue. Must listen for all of you. Reset to the weekend for Global Wall Street on the equity market you missed. We do that next. This is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
When you look at the health of the economy and the leverage in the economy, the U.S. banking industry has been deleveraged because of what happened in 08-09, and the U.S. banks are in very strong shape handling what's going on today. And should this economy do a soft landing, and that's the critical piece, then the stocks will do well going over the next 12 months. But if we hit a hard landing, it's going to be very difficult for the banks.
Some of you have a younger persuasion and may go, who is that guy on radio and television? He is Gerard Cassidy. He is of many years of experience at Tucker, Anthony, and R.L. Day, and then this and then that. And I think he's worked for like 42 firms over the years. He is definitive on the banks, and he has a certain style to his research that's a huge value. We thank Gerard Cassidy for his commitment to Bloomberg Surveillance. He's been great, and that he sends along that crate of 12 lobsters every year from Portland, Maine.
He does not. He does not bribe us with lobsters, just for the record, to, just set the record straight, lest anyone think otherwise. But carry on, Tom.
They show up, and Mr. Bloomberg walks in the door and goes, what's that smell?
Yeah, live, crawling around your desk.
There it is. Gina Martin Adams with us right now on a Friday as we reset for your bear market summer as well. Gina Martin Adams, sell in May and go away. How's that working out?
Yeah, not so well. As a matter of fact, we actually published research last week suggesting, look, July is actually one of the seasonally strongest months in the market. So even the sell in May, go away sort of notion really ignores the fact that July tends to be very seasonally strong. It tends to be one of the strongest earnings seasons. Just quarterly seasonal earnings, seasonal trends tend to work in this month specifically. So it's tough to play those games.
Right.
Cute in summer just tends not to work particularly well, and particularly, especially when we've seen some broadening really emerge throughout June. We've seen the market perform quite well so far.
Take the world-class fundamentals of Bloomberg Intelligence and drag it into the emotion in our collective memories of the 3rd and 4th week of August. Things always get challenging the end of the summer. Are we prepared for that?
You know, I don't think the market is necessarily prepared for that because we've been getting more and more optimistic throughout the year. I mean, really, in the spring months, remember, everyone was talking about this really narrow market. It's not particularly optimistic. We've only seen, you know, performance really concentrated in the biggest of the big stocks. That narrative changed a lot in the month of June and continues to change throughout July, where we're seeing small caps finally break out. We're seeing broadening to some of the value-oriented sectors in addition to some of the growth leadership that we've experienced so far this year. We probably need to continue to see that for the market to perform because we can only sort of land on the shoulders or ride on the shoulders of the giants for so long. As we get closer to the end of August, that's when we'll start to get some real tangible evidence as to what's happening with interest rates as well with respect to the economy. Remember, there's about an 18-month lag between economic performance and interest rate changes. And so we will start to see if there are negative impacts to the economy. We most likely will start to see that late this year and into early 2024. And that's the volatility that we'll have to contend with. But, you know, I think the market at large has just started at a more optimistic sort of tone. Certainly that can continue if we continue to see very strong earnings, as frankly, the earnings from the banks so far have blown away consensus expectations, in particular for that space, which has been so beholden with negative sentiment right now.
So let's drill into that. Is this when we're going to start to see people diving into financials? As we heard Anastasia Amoroso coming out and saying she's starting to find appealing that particular sector.
You know, I think we're a long way from that, frankly, because the biggest of the big banks are not where the weakness was expected to be. Certainly, they've done much better than expected. But the real weakness in the financial sector is expected to be in the regionals and some of the smaller banks, which have yet to really discuss you know, what's going on with their trends. So I think we need to wait a little bit to get deeper into earnings season. I think the consumer finance companies could also be incredibly interesting over the course of this earnings season. How are they contending with higher interest rates? How are the consumers? What is the consumer behavior shift with respect to higher interest rates? How desperate are consumers to take on debt? We'll get that out of the consumer finance group as well. And then, frankly, when you look at the broad financial sector, insurance is a huge portion of financials at large. It's not just banks. I think we tend to focus a lot on banks as an economic indicator, but insurance companies are really the leaders in the financial space in terms of fundamental trends. They've done reasonably well in terms of price trends also. So I want to watch those insurance companies, too, for signs of potential weakness and or strength.
Gina, it's been a huge week. Every guest that's come on the set this morning has said, wow, what a week. Perhaps not Monday and Tuesday. But after that, we got a complete reset with our expectations of disinflation taking hold, as well as strength, whether it was lower than expected jobless claims or the earnings that we're getting increasingly. How have you reset? Do you think that this has been a sea change kind of week amid the precipice of a downturn in inflation that's set to accelerate?
Look, no single week makes a huge sea change for me. I mean, we have been talking about inflation ad nauseum for the last 2 years as the primary driver of equity prices. So for us, the consequential shift really was in the December-January period where we were getting some really clear evidence that inflation was turning from a headwind for stocks into a tailwind. And that's really just continued en masse over the course of the last several months. What we got this week was a confirmation that inflation is still decelerating significantly more than many people had anticipated. It is relatively contained, and it is very supportive of margin conditions, importantly for the S&P 500. So as much as, you know, we did get confirmation of this week, it wasn't necessarily a big change for us. It was just a continuation of the trend. I'd say the one thing that did potentially change this week was initial claims. We did have a pretty significant deceleration there, and I would watch that for continuation as well going forward.
Gina, your claim, which goes back to the last time the Red Sox won 10 games in a row, the famous Gina Martin Adams claim is you're in the market. In the phrase of New England, you're a player. You're always in the market participating. What is the behavioral process of bears now who've been wrong on this bull market run? How do they work out, publish, rationalize over the next, say, 4 weeks?
Yeah, almost to a person, the bear case is made based on higher interest rates ultimately constraining economic growth. And this goes back to what we were talking about a little bit earlier, is there is this underlying tension with respect to the traditional relationship between interest rates and the economy. And there is an underlying assumption in the bear case that ultimately at some point in the future, we don't know when, maybe it's the second half of this year, maybe it's 2024, maybe it's 2025, but there is this underlying uncertainty with respect to how will the economy contend with much higher interest rates. That is the bear case right now. And that feeds through to several things, such as, oh, interest rates are too high for stocks, valuations are too high. You hear all of these narratives, but really it is about interest rates. Now, the trouble with this case is, so far, these higher interest rates have only slowed economic growth. And frankly, inflation has been the bigger story that has driven the equity market. So maybe ultimately we do have some sort of bearish correction, but until the data tells you that it truly is coming, you have to participate in the equity market. And that is our core belief, is follow the data, follow the models. What are they telling you right now? The data and the models have been very constructive, really, since the end of 2022.
Gina Martin Adams, thank you so much. And what we know, folks, as equity animals, Gina Martin Adams and myself, is the world of Bramo actually has some serious credibility. I don't think this has been said this week, Lisa. Your world of credit absolutely nailed this over the last 3 months. Credit spreads did not widen out. Credit spreads were optimistic. Corporate credit, as compared to full faith in credit, said, no, we're narrow. There's an optimism. We're bid. Folks, I got goosebumps, ducky bumps over this, Lisa. Credit nailed it this time, and once again.
In fairness, so did meme stocks, right? I mean, they also gained everything. Everything was like, no, but there was a real risk on feel as people believed in this recovery. They're horrible influence on many levels. Right now, what we are seeing as we get these bank earnings, though, they also gained everything. Everything was like, no, but there was a real risk on feel as people believed in this recovery. They're horrible influence on many levels. Right now, what we are seeing as we get these bank earnings, though, is a resilience. Although on the margins, some signs that you do see a levering back up of the consumer. The Citi CFO said that, get this, said credit card average loans rose 14% in the quarter.
Yeah.
People are charging all of their trips, all of their airplane tickets for the points, maybe not, but on their credit cards. And the banks are there for that. They say, great, you want to pay us 25% if you don't pay? Great.
Is Citigroup basically Visa? Are they basically a charge card company that has a bolt-on bank?
Well, I won't go that far, but you are seeing an expansion of consumer credit extension.
Cut up the plastic this weekend. That's a summary from Bramo.
It's for the points.
What you need to know is futures advance up 9, Dow futures up 187. Extraordinary. Have a good weekend. Maybe am I here Monday?
You are.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
Brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. We're advancing here for a 5th consecutive session. From New York City, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, equity markets heading for a big week of gains. As the latest data fuels soft landing dreams, JP Morgan kicking off earnings season on Wall Street. We begin with the big issue. Here come the banks.
We're laser focused still on the banks.
Bank earnings. Bank earnings are going to continue to show a challenged outlook.
Challenges for the larger banks.
It is a very tough environment. A lot of investors are laser focused on capital.
On the lending side,
lending growth doesn't look particularly good.
You are seeing lending growth slow,
particularly for the larger banks.
From the deposit side,
some banks will have some deposit pressure.
We're going to identify the issues that banks are going to have to pay for deposits.
Banks are needing to pay up to shore up their deposits.
I would look at credit quality.
Credit trends.
How is credit being distributed across the system?
Some banks are going to be much better placed than other banks.
It's probably an even more pivotal time for the regional banks.
This earnings season is going to be super critical.
The perfect individual, a good friend of mine, this program to wrap up this week, Mohammed Al-Erin of Queen's College, Cambridge, amongst other things, of course. Mohammed, wonderful to catch up with you. Better earnings, better data, bonds rallying this week, equities rallying this week. Let's start with the number one question of the week. Is inflation on a sustainable path back towards 2%, or is there reason to believe it reaccelerates later this year?
We don't know, John. It's going to depend on what happens to service inflation. We need service inflation to come down before goods inflation goes back up, and goods inflation will go back up at some point. So we need a lot of help on the service side. But John, you cannot get in the way right now of the soft landing narrative. That narrative is building momentum. It is stronger than it was last October when it handed off to something else. But everything we've seen so far this week, CPI, BPI, the banks, it's all been about a soft landing narrative, and that narrative is on the go, and I wouldn't get it in the way of it right now.
Andrew Hollenhorst, the city, has changed his view on policy over at the Federal Reserve. He says hike in July, was looking for a hike in September. He's pushed that out to November. He said this on inflation. The soft inflation story may last for several months and possibly the remainder of the year, but still tight labour markets and a rebounding housing market risk of reacceleration in inflation late this year or early next year. Mohammed, talk to me about that window, that soft landing, soft inflation story. You sound a little bit more constructive, not just on the economy, but dare I say this market too?
So we are definitely in a good window for inflation data. It will last into September. Partly it's base effects, partly it's what's happening around us, partly it's the feed into production from the PPI. It is what happens thereafter, John. And when you look at the components of inflation, it is critical, and you just cited, it is critical that we don't get certain components moving back up before service disinflation has established traction. That is the bet. There's two big bets out there right now. One is that the inflation decline will be linear. Too early to bet on that. And the other one is that the Fed will stop after the next rate hike, which is in July. That if they're data dependent, they stop. If they are worried about their credibility and they remember the bad experience they had in 2021, they may want another rate hike as insurance. I would stop if I were them, but this Fed has surprised me so many times, John, that I don't know what they're going to do.
Well, never mind the bad experience of 2021. Let's talk about the experience of early 2023, when the chairman started to embrace the disinflationary process. Mohammed, when we get to the news conference at the end of this month, Jackson Hole in August at the end of next month, do you expect to hear the same kind of thing again? Or do you expect to hear what we heard from Chris Waller, the governor, overnight? I see 2 more 25 basis point hikes and a refusal to embrace the inflation data of the last month.
Yeah, I mean, we've had 3 speakers so far, and all of them have pushed back against the dual hypothesis of linear disinflation and 1 hike, and that's it. They're not ready to give that up. Now, there's a lot going to happen in the next few weeks. John, the big story of the year is what did not happen rather than what did happen. We did not get a recession. The hikes, which have been significant, did not weaken the labor market. Credit contraction has not happened. The banks haven't suffered yet from inverted yield curves, concerns about depositors looking for higher deposit rate. It is all about what has not happened. This is the big, and this is why so many people have been surprised with their recession calls, with their market calls, because a lot of things simply have not happened.
Let's explore that a little bit more. Mohammed, there are some people who believe that the tightening cycle of the last 12 months still hasn't bidden. What evidence is there that the improving inflation data is a consequence of the rate hiking cycle that started in March of last year?
I think the evidence comes from the goods sector, is that you've had significant impact on rate-sensitive goods. And that is what has driven inflation down, along with the reversal of the surge in energy and for the U.S. in food prices. So that is why we're getting these good inflation numbers, and they are to be welcomed. The problem, and you know that was the concern I've always had about the Fed being late, is that inflation migrated to the service sector and to wages. And the problem when that happens, as we all know, is that is less sensitive to rate hikes. So that is where the service versus goods element comes in, and it's critical that we see the disinflation on the service side.
Going to be interested to see how the next 12 months materializes, evolves with that in mind, Mohammed, and the longer variable lags of policy, how it starts to come through the pipeline and starts to bite in this economy. Torsten Slog has really been on top of this over at Apollo, a man I'm sure you know well, Mohammed. He said the flawed logic in the current market narrative, this is what you and I are discussing right now, the narrative of the moment, embracing a soft landing, hopes and dreams. He pushes back. He says this: the lagged effects of Fed hikes will continue to drag the economy down over the coming 12 to 18 months. That is why the recession is a more likely outcome than a soft landing. Never mind the narrative, Mohammed. Never mind what this market's going to embrace through summer. Is it still your base case, potentially, that we get a recession more than perhaps we get a soft landing?
So I haven't been in the recession camp, John. I've been pushing back over and over again. There's nothing automatic about a recession. We get there if there's another policy mistake. But the economy itself is strong and robust. You've heard me say this over and over again. Yep. This is an economy that surprises on the upside. But we can still get a recession if the Fed over-tightens, which is a possibility. Then that takes you to the question of what is the effect of all the cumulative lags that are coming in. Look, the hard thing, you can make a recession call, but be careful of the market technicals. I mean, the one thing that has frustrated Dawson and others is the market technicals have been very strong, and you've got to respect the technicals. Those who don't get trampled on. And these technicals have embraced soft landing. There've been a consistent inclination to go higher, and now there's reason to go higher. The PPI and the CPI numbers were very encouraging to those people. I still think there are outstanding questions. One of them, you're right, the cumulative effects of the hikes. Two is the inflation dynamics. Are they going to be as accommodating as we want them? And then three is the Fed. And I think these are open questions right now.
Could you define policy mistake for us? They are communicating, projecting 2 more hikes. Is that a policy mistake that leads to an unnecessary outcome for economic growth?
So it gets us into the question of how quickly do you want to get to an inflation target, and what is the right inflation target? That is where your question goes. If you want to get to a 2% inflation target quickly, you will make a policy mistake. You will make a policy mistake for 2 reasons. One is my own belief that that is not the right thing to do. You don't want to get to 2% quickly. The supply side is disrupted. It's disrupted by geopolitics. It's disrupted by the rewiring of supply chains that the corporate sector is doing. It's disrupted by the labor market. It's disrupted by many things. So if you force 2%, you will contract demand much more than you should. So, John, we get into this very complex question. Now, is Chair Powell going to discuss this in August? I doubt it. The Fed, understandably, the Bank of England, the ECB do not want to go anywhere near the discussion of the inflation target. And that's because they're worried about their credibility. They don't want to open that discussion until they've reestablished their credibility.
Slightly unfair of me to ask, but not on what they should do and what you expect them to do. Are they one and done?
That's what I would do if I were them, one and done, because I don't believe that we should be getting to 2% inflation quickly, because we will risk breaking something. And when I say breaking something, there's 2 aspects to it. The economy, with the vulnerable segments of society being most vulnerable, and 2, the financial sector. There's still a lot of things to happen, particularly in the non-banks, John. We've talked about commercial real estate. It happens slowly. All this refinancing don't happen instantaneously. They happen slowly. So we've got to be careful not to shoot ourselves in the foot yet again.
It's the policy trilemma you've talked about all year, that exchange between growth, inflation and financial stability. Mohammed, wonderful to catch up with you and wrap up the week. Mohammed Al-Arian of Queen's College, Cambridge. And it's been quite a week. So far, so good. CPI, PPI, take your pick on the inflation pressure stuff. Take your pick with the earnings. Banks this morning, yesterday PepsiCo, Delta, equities up once again by 0.1% with some price action. Here's Abby.
Yeah, John, a bit of a bullish bank here for the earnings season that we are starting to see, and especially with those big banks you're talking about. We have the likes of JP Morgan, Wells Fargo, and Citigroup all trading higher. JP Morgan put up record revenue of $41.3 billion, $21.8 billion of net interest income. That's an all-time high. Rates going higher have helped the banks, it seems, as opposed to hurt. That had been the fear coming into this earnings season on interest expenses to be paid out, but it's not working out that way. Wells Fargo up 3.6%. They have lifted their net interest income guide after reporting $13.2 billion in the last quarter. And Citigroup, they're getting a little bit of a lift from fixed sales and trading meeting estimates, plus a boost from credit card spending. 11% jump there for personal spending for Citigroup, John.
Abby, thank you. Coming up, the big banks kicking off earnings season with better than expected results.
These companies are very profitable even with higher credit costs. It's very encouraging when you see numbers like this. If we go into a soft landing, this profitability for the group is going to remain very strong.
JP Morgan, Citi, Wells Fargo topping estimates. That conversation up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep,
mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Focus on the economy and the strength of the results and performance. This was a good quarter. We thought this would be the trough of the investment banking cycle, and we are seeing green shoots. The strength of the consumer and commercial loan activity is very promising, and size matters here.
Earnings season kicking off with the big banks reporting better than expected results. Wells Fargo boosting its guidance. JP Morgan's Q2 revenue soaring to a record. The CEO, Jamie Dimon, saying this. The US economy continues to be resilient. Consumer balance sheets remain healthy. Consumers are spending. Shanali Basak, so far so good.
So far so good. Not only do you have a record quarter for JP Morgan, John, if you could believe it, this year with $87 billion of net interest income expected, it is going to be the biggest year ever for JP Morgan on that number. Now, what it's showing you is it pays to lose some money to make some money. We are watching credit costs starting to go up over at JP Morgan, over at Citigroup as well, over at Wells Fargo. However, you're seeing Wells Fargo and JP Morgan, as you said, raise their net interest income guidance. Now, ever the cautious man here. You have Jamie Dimon speaking to analysts as well. There's a lot of questions about normal. What is normal? Normalization of net interest income. And he is not really telling you what that normal number really looks like year after year after year. However, even though he says that the consumer is strong, he does say that to the economy, the headwinds are substantial and somewhat unprecedented, and that people should take a deep breath. And that even with the investment banking progress that they're making, that you can't really see a trend yet with the numbers you're seeing so far. So yes, blowout numbers here from JP Morgan. You're seeing positive across the board at the biggest banks. Next week could get choppier when you look at the regionals. We know that they don't fare the same way when you look at some of these businesses and the amount they're taking in relative to the amount they're taking out.
Shanali, stay close. The open about 14 minutes away. We'll catch up with you then. Joining us now is Morgan Stanley's Andrew Sliman, alongside him TPW's Jay Poloski. Gents, so far so good for the whole of this week. Andrew, I want to go back to a quote of yours from earlier this year, in the last couple of months. If I were a financial advisor and it gets to October, November, and I haven't made money for my clients because I'm heavily in cash, I would start to get nervous. Cash starts to get back into the market later in the year. Andrew, do you want to bring that forward a few months?
Sure. Look, I thought good morning, Jonathan. I thought the market would have a pullback this summer because we've had a great move, but I'm really questioning that because if you look at the fund flows, they're still not positive. And so that tells me retail has not capitulated into the market, and they always do. They're always late to the party. They re-entered after COVID in February of 2021. That's when flows turned positive. So I think that is still out there. And as to my quote, investors are going to get nervous. Advisors are going to get nervous if they're underweight in equity. So I think that, and they've been sellers, that will reverse sometime later this year. And I just don't think you're going to get a pullback because every pullback's an opportunity to get that cash back into the market.
Jay, are they nervous right now?
We're certainly not nervous, John. Here at TPW Advisory, we've been fully invested all year and quite constructive on risk assets, as you know, and we've discussed on this program. But you had Mohammed from Queens College on just a few minutes ago, John. So I want to give you a quote from a British band and see if you can guess the band, because this is what we're thinking about. When facts rock fiction, always cause friction. And the facts, better jobs numbers, better CPI, better PPI, better earnings, are rocking the fiction of bear markets and recessions. And so the real point is that over-tightening risk by the Fed has been removed, and that puts a mantra of ours into play, which is the Fed on hold equals a weaker dollar, worst week for the dollar in 3 years, and a better opportunity set in rest of the world equities and commodities, and copper and oil have been on fire this week.
So, Jay, go through it. Regionally, geographically, the S&P 500 year-to-date up 17%. Euro Stoxx 50 before today up 16%. The Nikkei in Japan before today up 24%. Jay, where do you want to be?
Yeah, so John, here's the point, right? Commodities have been a huge laggard, and emerging markets have been a huge laggard. And I just want to give you some numbers from just the last 5 days. The Q's up 3, S&P up 2, EFA up 6, copper stocks up 11, KWEB, Chinese tech up 14%. China is the place to be in EM right now, and commodities are the place to be. The Goldman Sachs Commodity Index just broke above its 200-day moving average. So the opportunity is to take some profits in the U.S. tech space, the digital space, stay long your cyclicals because we're in an early recovery in the global economic environment, and look to opportunities, particularly in places that have not yet participated. This has been a market of rotation. We wrote about it. We titled our musings 2 months ago, literally 2 months ago to today, rotation. And that's what we've been having. And the market is now starting to rotate to the commodities and the emerging markets because they're going to lead the next cycle, which is a rate cutting cycle. We're done with the hikes. We're moving to cuts. EM and commodities, the place to be.
Andrew, let's play this out a little bit further. You've talked about the FOMO, the cash on the sidelines. Cliche stuff, I know, but could come back into play. Andrew, if you're right and it comes back into play, does it go into Jay's world, everything he's just described, or does it chase the winners this year?
I agree, because the number one question I get is, how do I get back into the market and not feel like an idiot? I'm just chasing the S&P. And as much as your point, Jonathan, you mentioned the returns are pretty good for international, but the valuation is still so much cheaper. So I think there's a perception that it's still early in the rally there. So I think it's all about the broadening out of the market, opportunities beyond the S&P. I think people will feel better about moving into those areas than just simply chasing the S&P, which is essentially the mega cap trade.
Mohammed endorsed this view that maybe there's a window here over the next several months where this inflation data comes in line with these hopes and dreams of the soft landing crew. This is the pushback from Andrew Holdenhorst, and I'd love to get a response from both of you to this. Andrew says this inflation soft spot might last several months and possibly the remainder of the year, but still tight labour markets, a rebounding housing market, risks of re-acceleration in inflation later this year or early next year. Jay, what would your response be to that?
Yeah, we wrote about this a month or two ago, John, called The Birth of the New. We are not going back to the low inflation, low growth world of 2010 to 2020. We're moving into a new world, a world of new industrial policy where governments are active, more active than they've been in 50 years, where the central banks are going to accept a slightly higher inflation number. We're thinking 3 rather than 2. They're not going to highlight it, but they're just going to accept it. And an environment where, with the reshoring and the realignment of supply chains, all 3 regions of the world, our tripolar worldview, are self-activating and are able to produce and finance and consume independently of each other. And so we're constructive on global growth. Our analog is the second half of the 90s, where you had higher for longer. 4% 10-year is a feature, not a bug, of the future environment. So better earnings, CapEx boom, AI innovation cycle, We're constructive for the next several years, John, and we think we're in a new cycle, a higher growth cycle that's going to be good for risk assets.
Andrew Sliman, I've got 30 seconds left. Final word, please, sir.
Look, at the end of the day, next year's consensus earnings is $246. Now that he might be right, but we may not find that out till the end of this year, early next year. And right now, that number is an inflecting number from negative growth to positive growth. And historically, the market puts a big multiple on that. So I think we're going to pull the returns from next year into the second half of this year. And I'm more concerned about the economy and returns next year than this year.
Interesting. Andrew, Jay, you've both been bullish this year, bullish and right so far this year. Andrew Sliman, Jay Pawlowski, to the both of you gents, have a great weekend. Fantastic to catch up. Coming up on this programme, the morning calls, and later, the US banks rallying on better than expected results from the likes of JP Morgan and Wells Fargo. We'll catch up with RBC's Laurie Calvasina.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Equities pushing just a little bit higher on the S&P. Let's get you some morning calls. JP Morgan downgrading AT&T to neutral, pointing to increasing competition and weakening growth in its wireless business. Raymond James upgrading KB Home to outperform, expecting the home builders to keep rallying as housing demand continues improving. And finally, UBS upgrading Microsoft, recommending investors build positions as cloud spending stabilizes and AI drivers start materializing. That stock up by 1.4%. Up next on the bank, Shonali Basak, David George, Laurie Calvasina of RBC. Your opening bell just around the corner.
think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Can we complete the sweep on the S&P? 4-day winning streak on the S&P 500. Monday, Tuesday, Wednesday, Thursday. Can it be a move higher on Friday? Equity futures slightly positive by 0.15%. The data this week better than expected. Inflation a bit softer. Earnings so far so good. There's the opening bow. Switch on the board and get to the bond market. Stocks rallying this week. The bond market rallying too. Treasuries advancing, yields lower. That's the theme of the week so far. On the session, up by a couple of basis points. Your 10-year, 378.90 on the week so far, down 27 basis points over the last 5 sessions. Into the FX market, the euro just about positive for a 7th consecutive session. Equities up. Treasuries better, yields lower, dollar a whole lot weaker this week. Euro dollar 112.28. Crude negative 0.4%. We're down to about $76.60. Into the session we go, about 30 seconds in. We're positive by 0.2% on the S&P. On the Nasdaq, up by around about the same amount, by 0.2% as well. One sector to watch at the open, the financials. JP Morgan, Wow, Citi, all topping revenue estimates as a result of higher interest rates. Abby has more. Abby?
Hey, John, and yeah, very nice quarter for these banks, and we have the stocks popping as a result. Better than feared for sure, because there had been some expectation going into this quarter that there could be a real issue around interest expense, but that simply didn't turn out to be the case. As you mentioned, topping estimates for each of these companies relative to sales. For JP Morgan, record revenues of $41.3 billion, their net interest income at an all-time high, and those rising rates helping, not hurting as had been feared. Wells Fargo also net interest income strong. They lifted that guide. The deposit costs up more than 1%, but still the stock is higher. And Citigroup, the second biggest credit card provider, well, an 11% jump on personal spending. The FICC trading solid. The big question here, John, is on the year, these stocks are underperforming the S&P 500 into today by 7 to 10%, so not minor underperformance. Were these quarters good enough to provide a rotation into the financials?
Abby, thank you. We've talked a lot on this program over the last few days about the soft landing hopes and dreams fueled by the economic data recently. Plenty of Fed speak out there. Austin Goolsbee of the Chicago Fed, a dovish member of the committee right now, saying this: there is a path to curb inflation without recession. That's what the bulls are hoping for. That's what the likes of Jay Pelosky, Andrew Slimmon so far this year at least, are looking for. Let's get back to the banks. JP Morgan, Q2 results. Jamie Dimon just about wrapping up the earnings call. Shonali, you've been listening to that. What's he have to say?
Listen, they give you a word of caution for the economic environment, but so far so good when it comes to the consumer. Not just a record quarter, but a record year with net interest income. I want to flow through across the banks, though, because we've been talking so much about the good news, it's worth pointing out what the bad news is ahead. That is worries still about commercial real estate. Wells Fargo's call coming up at 10 o'clock. Goldman's earnings next week, according to Semaphore, is about to have $2 billion worth of write-downs tied to both green sky loans as well as commercial real estate. So we'll see some pictures there about what that could look like. Wells Fargo also raising its expectations for expenses, partially tied to severance, and Citigroup's expenses also coming in above line for expectations here. But all in all, people are happy with the lending. That is all the green you're seeing on the screen here, John. Even though charge-offs are going up just a little bit, you have the biggest of the big benefiting from people taking out loans on their credit cards. But again, that is not the case if you're not the biggest of the big, and I think that will be the big story going into next week.
Anything to point to this morning, Shonali, just in the way that these stocks are trading? I know it's super, super early days and perhaps unfair to ask this question, but the gains in JP were a little bit firmer earlier on. They're just about sticking right now, and Citi's turned negative.
Well, because when you're buying the stocks, you're buying into the long term, aren't you? And to the point here is like a lot of these stocks that you're seeing on the screen have been up anyways on the year. Citigroup has been trading at about half of its book value, so they had the most upside because they were the most sold off over a longer period of time. But listen, what these executives are addressing right now, JP Morgan, Citigroup, is that tighter regulation, which is that longer term overhang, both in terms of capital return as well as returns on equity, as well as losing business. As JP Morgan's Jamie Dimon puts it, the private equity guys are dancing in the streets.
Shonali, thank you.
Is moving.
Looking forward to your coverage over the next week or so. Shonali working hard as bank earnings kick off on Wall Street. Plenty of commentary from the analyst community this morning, including from Oppenheimer's Chris Kotowski, who had this to say. The key takeaway from JP Morgan's print should be that all the fears about deposit beta swallowing up all the benefits of rising rates was way overblown. Oppenheimer reiterating its outperform rating following those results. That stock is up by around about 1%. That's Chris Kotowski of Oppenheimer. Earlier today, we caught up with Gerard Cassidy of RBC. This is what he had to say.
If we hit a hard landing, it's going to be very difficult for the banks, including JP Morgan, but that doesn't appear to be the case, at least today.
Joining us now, David George. David, wonderful to do this with you around the opening bell, as always. I want to go back to the work of Oppenheimer, if I may. When Chris Kotowski said this, the key takeaway from JP Morgan's print should be that all the fears about deposit beta swallowing up all the benefits of rising rates was way overblown. David, do you agree?
Yeah, I think that's right. In addition to some of the issues around deposits, I just think that it's important to understand that a lot of these banks, particularly the large ones, have significant earnings ability and flexibility to absorb higher credit costs. JP Morgan, for all of the negativity around financials, they made $14 billion, John, in 3 months. So again, they're a very resilient system. And I think the numbers this morning corroborate that for sure.
We often focus on net interest income, net interest margins. Are there reasons to believe that those metrics get better or worse in the months to come?
Well, I think one of the keys for NIM going forward is I think over the next quarter or two, particularly for the regionals, we hopefully will start to find a bottom and start to find an inflection point with respect to funding costs and some of the funding competition that's been really front and center for the bank group. And I think if the Fed is close to being done and potentially starts to hint at a cut, I think that will really be probably a meaningful positive catalyst for these stocks as we go through the balance of 2023.
Credit quality was another issue, a dimension of these earnings that many people were focused on. We did see some provisions for loan losses start to get built up again over at JP Morgan, in fact, in a bigger way than expected. David, is that something to worry about, something that concerns you?
No, it's not. I think clearly credit cannot get any better. We have come off significant stimulus, significant actions on the part of both policymakers in Washington as well as from the Fed. And that is we've had very low credit costs for a very long time, and costs have to go up. The good news is, John, we think in large part that credit costs are going to be pretty manageable, and that we are just expecting a more normal credit environment in 2023 and 2024. And fortunately, we think expectations are grounded enough that that the company should be able to hit that bar, if not jump over it over the quarters to come.
Well, that has big implications for how these stocks trade, so let's talk about that. David, because of the events of the last few months, the regulatory backdrop obviously is getting a little bit louder. Does that put a lid on the potential for these multiples, the valuations of these companies, to get better?
I don't think so. I think at the large end, they're already highly regulated. So I think at the money center area, I don't think there's going to be a meaningful change in regulatory backdrop. I do think as you go down the asset size spectrum, Jonathan, you'll see more regulation among the 100 billion in assets to 250, and that's going to be centered, we think, largely around liquidity. We also think there'll be some capital adjustments as it relates to incorporating these bond market or mortgage-backed security losses that have been kind of a near-term mark-to-market challenge. But in large part, where valuations are, particularly for the regional banks, we think expectations are extremely low. Sentiment is very negative, and the risk-reward trade-off, even despite a nice move over the last several weeks for most of the banks, is very constructive in our opinion.
David, I know you've got to run to get back on the phone and talk to clients. Just one further question. Top pick right now.
Yes,
what
sir.
is it?
Our favorite here is Comerica. It's a regional bank based in Dallas. The stock trades at just around 6 times earnings. We think it's an excellent risk-reward trade-off, and the stock has, we think, 60 to 80% upside from current prices.
We'll talk about the regionals over the next week as well. David, thank you. Appreciate it as always.
Thanks,
Let's try and
John.
catch up again over the next week. David George there of Baird on the latest from the financials. Sticking with the financials, RBC's Laurie Calvasina upgrading the sector, saying this: it's driven by our optimistic performance outlook and the indication that valuations are attractive. Dividend yields are compelling, and earnings and sales revisions have shown some signs of improvement. Laurie, I'm pleased to say, joins us right now. Laurie, upgrade to the outlook on earnings from you overnight, on the sector, on the financials. Do you like what you hear this morning?
You know, I certainly like the headlines so far. I haven't managed to catch up with Gerard yet, but we did recently do a survey of all of our analysts heading into this reporting season, not just in the U.S., but across the globe, and we found that our financials team was really resolute in terms of their optimism, and maybe, you know, a slightly more neutral, you know, view from our regional banks team, but even there, when I told them I wanted to upgrade the sector, they said they thought this was going to be the right call, you know, if we could sort of get past this quarter, and we're looking on a 6 to 12 month view. So we think on balance, you know, when we're coming up with these positioning calls, we're really looking for relative opportunity. And I think some of the comments that were just made by your previous guest talking about fears are overblown, that is often how these things get started. We actually saw tech really benefit from the idea that fears in that space were overblown. We started to see earnings revisions turn around. We're at a similar point now in the regional banks and the small cap financials that tech was a couple quarters ago, when the earnings sentiment was just really, really terrible and had nowhere to go but up.
So, Laurie, let's build on these estimate changes you've made. Given everything you've just said, are you anticipating this to play out then in a broader equity market rally? Opportunities elsewhere? Does it come through at the index level at all? Did you change that call overnight?
So we haven't changed our target on the S&P. We're still at 4250. That's our base case. And frankly, it's the median between sort of 3 bearish scenarios and 3 more bullish scenarios. And that's been really the tension in our forecast all year, is that our more cross-asset driven models, looking at bonds versus stocks, are arguing for caution. And many of the equity-only focused indicators are much more optimistic. Now, what I see when I look at the sector performance, things like growth versus value, small versus large, we're starting to see things like the growth trade stalling relative to value. If you just do a relative ratio, small is starting to break out a little bit versus large cap. I still like my tech stocks, but I think this market is telling me in terms of the performance recently that it is ready to rotate. Now, what happens in terms of overall index performance, if you get that rotation away from these big mega caps back towards value and cyclicality, that might not result in a rip-roaring S&P 500 kind of move, but I think that you can have that kind of rotation without any kind of big damage to the S&P.
So far this year, and it's been quite a run, the tech level story has just been amazing. The dominance of some big names on the S&P. Laurie, it's reminded some people of the pre-pandemic world, and they're wondering whether we go back to that. Low growth, lower inflation, low interest rates, and secular themes dominating in the absence of all of the above. Now, Laurie, do you push back against that?
Well, look, I'll tell you, it's something that I struggle with quite a bit. You know, I look tactically at growth. I see these indications that it's stalling. Growth looks expensive versus value again, similar to recent peaks that we've had in, you know, the past 5 or 6 years. If we look at the CFTC positioning on NASDAQ futures positioning, growth looks a little bit crowded. But if you think and kind of step back to what we're going through economically, it's either going to be a short, shallow, or skipped recession. What is the consequence of that going to be economically? I feel like at least for the next couple years, it's still going to push us into a sluggish economic growth environment. And the forecast for the next few years if you check the Bloomberg consensus, are for sub 2% GDP in both 24 and 25. Well, guess what? Growth stocks typically do well in that environment. And to your point, that's what we experienced really between the GFC and the pandemic. So I have some sympathy for, the kind of swelling and the ballooning of those parts of the market, because growth is where you want to be if you think economic growth is going to be sluggish. Tactically, though, it may be time to take a little bit of a breather.
So just in terms of this broadening out, this is a tactical call. It's not a long-term 1 year, 2 year trade.
I think in terms of, when I talk about financials, right, is it necessarily going to be the sector I want to be in over the next 5 years? I'm not so sure that I'm convinced of that. But I do, especially when I look at my small cap earnings revision indicator. It's one of these charts that's typically, sort of hold your nose and buy. Nobody's taking numbers up. Everybody's taking numbers down. We saw that with the semis last summer, and look what's happened there. So, I feel like I don't know if it's going to happen this quarter, but I feel like over the next 6 to 12 months, we're going to have a really nice trade. But over the longer term, I have a lot of sympathy, for people who are talking about things like AI, who are talking about things like reshoring, who want to be invested in those secular growth themes, because I do think that is sort of justified on the longer term economic view for now.
Laurie, everyone who knows me knows that I read Barron's on a Saturday morning. And this weekend you were in it. Fantastic conversation. I actually got around to reading it eventually later on in the week, this week. Laurie, in that you talked about the restorative element of the 1940s and coming out of the Second World War. Can you breathe some life back into that conversation and help me understand how that plays into everything you've just told me?
So, the way that analysis came out, John, is I was talking to one investor after another in the first half of this year, really kind of 1Q, early 2Q. And I would take people through my sentiment model, which was very bullish, my valuation and earnings work, which was very bullish, and a couple other things. And people would be like, okay, fine, but, we've never priced in the recession before it's actually started. The market's never bottomed before the recession's even gotten underway. And so we actually told people, if you look back at 1945, there was one period where the market never priced in a recession at all. And the reason the stock market didn't price in the recession was because it was technical in nature. You had a big drawdown in GDP because you had a drawdown in government spending, but you had this pivot from sort of this wartime economy, which was, very unusual, had to be propped up, by massive government support through the war effort. And we were transitioning back to a normal economy. But in general, what World War II did and what all that government spending did and all the things that happened there was it really pulled us out of that Great Depression funk. And if you looked at the GDP stats, they were pretty scary in 1945. But if you looked at things like consumption and private investment, they were pretty healthy. We had a little bit of an uptick in unemployment. It didn't really go that far. I think it topped out a little over 4%. So in general, the economy was still pretty healthy. And the market was, pretty mature about it and said, okay, we can look through this technical recession and just march on through and trade on the fact that the underlying economy is still in pretty good shape. And I think that's really what equity markets have done this year as well.
I enjoyed the interview, enjoyed this conversation too. Laurie, always wonderful to catch up with you. Laurie Calvasina there of RBC, upgrading the outlook for earnings and looking for a move towards the financials, seeing some of that develop in the last few hours off the back of earnings from JP Morgan and the likes of Wells Fargo. The S&P just about positive by 0.2%. It's a fifth consecutive day of gains, Monday through Friday. We'll see about the Friday bit. Coming up, President Biden wrapping up his NATO victory lap.
The American people known since the end of World War II and the formation of NATO that our security rests in the unanimity among European and transatlantic partners, us. The world is watching to see, will we do the hard work that matters to forge a better future?
That conversation up next.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that
get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth. And countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
The top names in business are on Bloomberg.
For Indigo, this is a 500 planes order. That's the biggest order ever in terms of number of planes. It doesn't change the short-term perspective on ramping up the production.
All our aircraft deliveries are delayed. The supply chain that was really decimated during COVID.
It's a real challenge for all the OEMs at the moment, but we absolutely have to have those aircraft delivered on time.
Nobody covers business like Bloomberg, your global business authority.
American people known since the end of World War II and the formation of NATO that our security rests in the unanimity among European and transatlantic partner, us. Will we stand together? Will we stand with one another? Will we stay committed to our course? This week, Finland, the United States, and our allies and partners said a resounding loud yes.
President Biden touting a productive NATO summit. Finland officially joining the alliance, Sweden on the path to membership, and Ukraine remaining a top priority. The president saying, quote, "The one thing Zelensky understands is that whether or not he's in NATO now is not relevant, as long as he has the commitments that guarantee his security." The president now back in Washington, D.C., alongside Bloomberg's Anne-Marie. AMH, walk us through what, for many people, might describe as a decent week for this White House.
Yeah, it was a decent week. One, John, you, of course, been covering on the economic front the cooling of inflation data that Biden says is Bidenomics at work. But obviously on the foreign policy front, the president really wants this to be front of mind for American voters, not just that he was able to keep NATO united amongst Russia's aggression in Ukraine, but that it was able to expand with giving this path forward via Turkey for Sweden to join the alliance. That was done on this trip, as well as really a U-turn from President Volodymyr Zelensky, which went into the NATO meeting very angry, and that tone really shifted to one of appreciation for the group and for the American president. But for this president, really what he was trying to convey was to American voters the contrast he can be as a foreign policy hand versus his predecessor, who also happens to be the front runner who will be running against him potentially in 2024. Because, John, he went back to the exact same presidential palace to give his press conference, and that was where the former president said that he believed President Putin when he sat down with him when it came to the 2016 election meddling, not his own intel. So the president made two really important remarks there. President Biden said that, one, Russia did meddle in our elections. And then secondly, he said that he can guarantee that Finland will be safe in NATO. And this is something that the former president used to go to NATO meetings and really try to rile them up and say that the U.S. would leave NATO if other members didn't reach their 2% spending target.
Well, let's talk about that 2% spending target. The former president complained, and many people assumed he was correct to. Anne-Marie, has the current president got those commitments from other members of NATO to actually fulfill what they agreed to?
Well, what we've seen out of this meeting is that the 2% target is now going to be the floor. It used to be almost aspirational, trying to get all of these members to hit 2%. Now it is the floor. You have to hit 2%. This is going to be difficult for some countries like Canada, Italy, Luxembourg, which are not there yet. But this is something that the group is really trying to work towards. And there has been pressure from the United States via the former president and also this president. I think when you talk to other members, foreign leaders, Jonathan, and their teams, what they'll say is just a lot of it is a lot of the same pressure and policy. It's just the rhetoric around it and maybe the bedside manners.
Anne-Marie, thank you. Wonderful work over at Lithuania. MH emailed me about 3 minutes ago, said I thought Saturday was for Premier League football. It is, and Barron's and, of course, Premier League football's taking a break. MH, thanks for that. Let's get you some sector price action. Equity's doing better this week, Abby. What do you got?
Yeah, they certainly are, John. We have the S&P 500 now up for a fifth day in a row, the first time we have seen that in about a month or so. Most sectors on the day are higher, not surprisingly. Well, it's interesting because healthcare is actually the highest. I was going to say, not surprisingly, financials up on top. They are higher, but underperforming the best sectors. On bottom, energy, utilities, materials. Let's take a look at that healthcare sector because so much attention going to banks on earnings, but we also have United Health absolutely soaring. They put up a better than feared quarter, and that is helping out some of the other healthcare indexes. So here's the defensive sector that is taking charge on this Friday, John.
Abby, thank you. Coming up next, your trading diary.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
26 minutes into the session, on course for the longest winning streak in around about a month. 5 days of gains on the S&P 500. Let's see if this sticks. We advanced by 0.3%. That's the price action. Here's the trading diary. Top of the hour. UMich consumer sentiment. Big bank earnings continue next week. B of A, Morgan Stanley Tuesday, Goldman on Wednesday, Tesla and Netflix as well. We round out the week with regional bank earnings too. From New York City, we round out this week for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. Have a wonderful weekend. This was the countdown to the open. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate while
This is a 3.
As the economic picture down.
Is it be okay? Is getting ready to make
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Jess Mitten and Simone Foxman here in the Bloomberg Interactive Brokers Studio. Happy Friday, Simone. I'm very excited about the next 3 hours with her Bloomberg Markets.
So am I. It's great to be back with you on Bloomberg Radio. And it's great to have an optimistic Friday morning.
Right, especially S&P 500 on track for weekly gains on the back of these bank earnings, right? But first, in the next hour, we're going to have Steve Matthews, economy reporter at Bloomberg News, is going to join us to talk to us about the latest on the Fed. And James Bullard is set to leave the central bank. We'll also chat with Allison Williams from Bloomberg Intelligence, of course, about this update when it comes to bank earnings. But first, we do have an important data point right now on consumer sentiment. So let's get the latest with a business flash on that with Bloomberg's Denise Pellegrini.
Yeah, good morning, guys. It's 10:01 on Wall Street, and we do have that breaking news on consumer confidence. This is University of Michigan preliminary July number coming in way higher than the estimate. 72.6, guys, compared to 65.5 was the estimate. And it's worth noting this is also the highest level since September of 2021. So consumers really rocking it here. And that's after all the bank earnings we got that are pretty bullish. Bank earnings broadly beat, including some big ones that we've been talking about here on Bloomberg Radio. That's contributing to the positive tone a lot this morning. And Anastasia Amoroso, Chief Investment Strategist at iCapital, well, she, needless to say, is sticking with her bullish call on the U.S. economy.
For now, I think we are on track for a soft landing. And I know, the bearish camp would say, well, you look at positioning and it's getting very exuberant, by some metrics. You look at, whether it's hedge funds, whether it's CTAs, all of those investors have, very quickly, very bullishly positioned. So, that leaves you susceptible to a negative catalyst. But can you name a negative catalyst right now?
She points to positive catalysts: inflation easing, Fed pausing, strong consumers. She's calling for 4,800 on the S&P, and Amoroso with us there on the Bloomberg Surveillance Podcast. Let's check the markets now. The Dow up 167 points. That's almost 0.5%. The S&P 500 up 11, almost 0.3%. The Nasdaq up 54 points. Let's call it 0.4% there. JP Morgan Chase up about 1.8%. Citigroup, though, it is down even after it beat credit card biz doing well there. Borrowers, though, struggling. Maybe some questions about that. We'll be talking about it here on the show. And Wells Fargo, it is up just about 2%. The yield on the 10-year right now, 3.8%, pretty close to yesterday. NYMEX crude, it is lower. We're seeing broad losses in commodities. Spot gold down 6 points now, call it 1/3%. Crude oils, I mentioned, down 0.7%. And what does it take, guys, do you think, to be one of the wealthiest people in the nation right now? What do you think your income has to be?
Oh man, I feel like I need to look at Rich Go, which isn't going to tell us, right?
Yeah, that's the top 0.001%.
Which isn't going to tell us how much we're going to make.
We're talking 1%, not for top broadcasters, but 1%, general population. Takes more than $650,000 a year to be among the top 1%. That's nationwide of the wealthiest U.S. households. This is according to the latest data from Smart Asset. Now, if you live here in the tri-state area in New Jersey to make 1%, you need $817,000, $770,000 in New York, and just because all their rich folks, rather, living up there in Connecticut along with me, I contribute on the other end, but $935,000 to be the top 1% in Connecticut. And if you're thinking you'll never make it there, just remember what it takes. That's all peanuts compared to what it would be to be the top 1/10 of 1%. A lot more zeros there.
Well, there you go, right?
That's your Bloomberg Business Flash. Stocks are higher.
Thank you, Denise. We appreciate it. And Bloomberg Markets is now on YouTube. Watch us every weekday starting at 10 a.m. on your TV, computer, or smartphone. Just visit youtube.com and search Bloomberg Global News. And Simone, looking at this latest flash when it comes to sentiment with the University of Michigan, it's looking at that rise. What another way to add to this Friday where you're looking at on a weekly basis, S&P 500, NASDAQ 100 up. You have these bank earnings coming in much stronger than expected.
I know, just an optimistic week here. And also, you look out to the expectations for where inflation is going to be, also coming in higher. One-year inflation expectations from the UMich index up to 3.4%. Which is actually more than last month.
I guess suggesting on a shorter term basis.
Yeah, just people suggesting that people just think this inflation is going to persist, maybe because they feel good about the money in their pockets.
And who better to join us to give us the latest breakdown on the markets than our own Bailey Lipschutz, who's on our U.S. equities team, one of our star reporters. Bailey, what are you watching today?
Yeah, you're looking at the S&P. You guys are talking about a strong week. We're on pace for the best week since the end of March. So obviously, a lot of green on the screen. You're looking at earnings from Wells Fargo, JP Morgan setting a positive tone, as is United Health. One of the big underperformers, Leslie's, which is a pool supply company, down more than 30%, record drop to a record low. When an analyst comes out and calls it a shocking guidance cut, it seems that will never be good. So coming in their fiscal third quarter pre-release last night, earnings 42% below Wall Street expectations. EBITDA for the year cut by 40%. So it seems like even though it's 90 degrees and I'm sweating on my way to the office, people aren't restocking their pool supplies.
Maybe they already have one, though. Maybe they have invested over the past couple of years, because one of the things that was interesting to me about this was that they said they were no longer able to pass on their price increases. Take me through your thoughts on that.
Yeah, no, when you look at kind of some of the comments that are coming from it, the company relies heavily on chemicals to help generate sales. So as the supply chain kind of shakes out and those costs get higher for Leslie's, the cost of buying chemicals to sell to consumers gets higher, it seems like consumers aren't budging. They're not willing to pay more money for those different chemicals that they would use to clean their pools. So taking this into stark contrast, you look at like packaged good providers, people are more than happy to pay up for Pepsi or Frito-Lay's brand, but that's not the case with pool cleaning supplies, because if you didn't stock up over the past year and a half, right now you're kind of batting an eye saying, all right, well, we're going to go to Amazon or find somewhere else to spend less money to maintain our pool. Maybe we're not going to clean it as much, which is not advised, is child of a pool.
Right.
I don't have a pool.
I don't have a pool either, but that's a really interesting factoid when you just think of consumers spending in the economy and how that all filters in. So Bailey, you do all things for us on the equities teams. You're not just looking at equities, but you're also looking at what's going on with SPACs, also ECM too when it comes to IPO market. What is that telling you, especially after the drought we saw in IPOs over the past year?
It feels like we're back. Obviously, everyone wants to talk about Kava. I've talked to a couple VCs in the last week who basically said, we expected Instacart or ARM to go public before Kava, but Kava still essentially doubling from that upsized IPO debut. One of the areas that I've spent a lot of time covering is biotech. We actually have a smallish deal, Apogee Therapeutics, ticker APGE, priced a $300 million IPO last night, which should debut today. And I was talking to a couple biotech investors yesterday afternoon, and they really said all eyes are going to be on this to really set the tone in terms of whether we will see a return to life sciences companies stepping in and raising cash, going public after what really has been a dormant 18 months where unless you were Kenvue spinoff from J&J or Mobileye off of Intel, it was really difficult to get generalist investors to really buy in to some of these new stories.
That's interesting to me too, because I would think, as a non-biotech specialist, that to some degree, biotech companies need the capital, and they're just always constantly going to be in the market, and therefore, you have to do an IPO despite some of this drought. But it seems like even they've been holding off a little bit.
Yeah, biotech is largely seen as kind of a leading indicator. So as you said, if you're advancing drugs, you're not selling anything. You still are going to spend tens of millions of dollars to raise cash to advance these products. But the big thing is that we had such a rush in 2020 and 2021 when everything was rosy. You had a lot of companies that were not even testing drugs in human yet, getting multi-billion-dollar valuations because money was free and people wanted to chase the next big thing. Well, when the music stopped playing, you still have 2 years that the IPO market was shut. So if you wanted to exit, you really needed to be bought out by a larger pharmaceutical company or look into your interior or current internal investors to try to raise cash to keep operating. And that's really kind of why we're seeing, again, maybe this will be the first signal with 2 IPOs, biotech IPOs pricing, but it'll obviously be fascinating to see how this plays out through the summer and really after that Labor Day period.
All right, Bailey Lipschitz, who's one of our star reporters on the U.S. equities team. It's always great getting a rundown on all things equities and then also what's happening with the IPO market. I want to quickly move over to our next guest. Who other better than to talk about the economy? We have Steve Matthews, economy reporter at Bloomberg News, who's going to join us to talk about the latest when it comes to the Federal Reserve. Also, James Bullard set to leave the central bank. But first, I want to get your thoughts just overall on the economy, Steve, because we did just get these big banks, especially when you're thinking about JP Morgan, Wells Fargo, Citi, reporting about not just, of course, their earnings more backward looking. This came over a tumultuous time when you think about the regional banks and the stresses that the banking industry went over, especially in the spring. What do you think this tells us about the direction and trajectory of the economy when you see these results?
Yeah, I think that's exactly right. I mean, the Fed has been looking at the economic data, but they've also been watching very carefully what's happening with the banking sector. And the reports we've gotten so far are kind of a green light for more interest rate hikes. I mean, the banks seem to be doing fine. There was a worry when we had 3 moderately big failures in March that, okay, this could kind of lead to, another series of bank failures and there could be some volatility and who knows where it would end up. And basically right now, things seem pretty calm and the big banks are doing, better than expected. I mean, the stock, look at JP Morgan and some of the others. The one caveat there is the Fed is really probably more focused on the regional banks and a lot of the regional banks and to see how they are doing. And a lot of those won't report until, next week or even the week after.
Did we get any indicators so far from some of these major banks about how the regional banks might perform? Because remember, at that moment of crisis, we saw a lot of deposits flood to these major folks, whereas some of the more regional players were left on the sidelines. Or are we really waiting until next week for the verdict on this?
Yeah, I mean, I think in the reality is we're probably waiting for next week, but these banks have done well. Their interest margins are doing well. Their credit worthiness is fine. There's been a lot of worry about commercial real estate. That doesn't seem to be a huge issue. I mean, it's a huge issue going ahead because you have all of these office buildings that are damaged by work from home. But in this quarter, it's not a particular issue. So the caveat again is that the regional banks have a lot more exposure to commercial real estate than, for example, J.P. Morgan.
Hey, Steve, something that struck me, looking at Citi's results, so it did get a boost when it comes to credit cards, but part of that was actually due to borrowers that were starting to struggle. You cover the economy so closely. What do you think this tells us about consumer spending right now?
Well, that's interesting, and we, as you pointed out earlier, we also just got the Michigan Consumer Sentiment Index, and sentiment of consumers has been fairly dire the last couple of years, and we saw a huge pickup in sentiment, both for how consumers are looking at current conditions, how they're looking for expectations, much higher than anyone expected. And that's kind of suggests that consumer attitudes are getting a little bit better. I mean, if this sticks, the thing that's driving this to a certain extent is inflation is coming down. So you're having disinflation. We had 3% inflation. At the same time, people's pay has been boosted recently because of the inflation. If you look at the average wages in the Atlanta Fed's wage tracker are running 5.6% year over year. So people are getting real wage gains. And to the extent that people are getting real wage gains, they have the ability to spend.
Yeah.
It's also a story of as you point out, of different segments. It's like, the rich are getting richer to a certain extent. I mean, a lot of the spending comes from the top half of the demographic segment.
To that end, you mentioned the consumer prices. We got those numbers in earlier this week. We also got producer prices. I mean, we seem to have two different narratives there. One, that consumer prices and producer prices are starting to disinflate at the same time as we have all this optimism, which really goes against the Fed, the traditional economic theory that, the Fed really needs to cause some kind of slowdown in the economy. Which numbers is the central bank watching most closely?
Well, if you listen to Fed Chair Powell, he's very focused on the labor market. I mean, there are, as you point out, two schools of thoughts. There's the Phillips curve thought that unemployment has to, go up for inflation to come down, and that there's this big relation